There's still lots of demand for equities.
Right now, we're in the middle of a good growth cycle.
What we really need to see is continued strong earnings growth.
Once again, we have these broad-based earnings surprises.
Earnings are opinion, cash flow is fact.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Friday, tech stocks bounce. Equity futures pushing higher heading into the weekend as Ken Griffin's Citadel is stepping in to help out a wiped-out hedge fund. South Korean investors are hoping the washout is very much behind us. The Kospi absolutely surging.
It's just amazing to see Samsung up 19%, to see SK Hynix up almost 25%. The bigger story here is, have we seen the leverage really come out of the system in a massive way, whether it's the retail triple-levered ETF buyers in South Korea, or whether it was once erstwhile $45 billion fund investing in tech that has now been whittled down to $10 billion and at the mercy of Ken Griffin. You put it together, people have more confidence that maybe we have reached some of the near-term bottom.
Well, let's start with the fund. Let's start with situational awareness, and let's talk about the positioning. Long hardware, short software with tons of leverage. And that's been wiped out, cleaned out, and you've had to unwind all that leverage. South Korea is one half of the trade, right? It's long hardware. That's been really struggling. You've got a bounce this morning. Can you say with confidence we've had the washout of positionings when you see the bounce back that severe in the Kospi? And as Guy Johnson said repeatedly earlier this morning over in London, you've got the biggest one-day gain on record in South Korea, and you're still down on the week. South Korea has been really volatile all week.
When you see moves of this magnitude, it's hard to say this is comforting because typically you want to see a gradual bleed upward. That said, it gives you a sense of what the feeling is right now on the street. Even Lori Calvasina came out and said right now you're getting to the point where value is being unlocked. In other words, the sell-off has gone far enough, and the price-to-equity ratios are starting to make more sense. So you have that fundamental story. As to the technical story, unclear, because when you have someone who is younger than 30 who's running $45 billion and is suddenly forced to face a call with the Grim Reaper and say, okay, you're right, here you go, it gives you a sense that maybe there are others out there.
He's still got some massive private market positions that reportedly he tried to offload as well. We'll spend some time on this throughout the programme. We'll spend some time on this too. Bring up the bond market and look at 2s, 10s and 30s. And let's just isolate the 30-year piece of the curve. And we'll look at this yield together. 520, yields down a single basis point. Do you know what we've done on the week on 30s? Just a bit of perspective. Yields are higher by 4 basis points on a 30-year yield. After a massive freak out at the Federal Reserve, a lack of guidance, a lack of clarity, a credibility test for the Federal Reserve, it's a move of 4 basis points.
Yeah, and I was actually looking back and I was going to say, oh my goodness, this is the biggest widening in yields in 30 years going back to, and it's like a couple months. I mean, it was like much more before. It was only up some 25 basis points in the past month. So to your point, we haven't seen as much of a freak out in the actual numbers as we have among some media commentators who freaked out.
I'm not saying there's space to be concerned. I certainly wouldn't say he did a tremendous job on Wednesday. I'm not going to try and say that.
This market's just sort of
just saying a bit of perspective.
Yeah, exactly.
You know, helpful into the weekend. Just a bit of calm. 30s right now, 520, 10s at 467. Coming up this hour, we'll catch up with Dan Greenhaus of Solus Alternative Asset Management as equities bounce. Tom Forte of Maxim Group as investors reward Amazon and punish Apple following quarterly earnings. Plus, we'll catch up with Thierry Wizman of Macquarie as Japan stages a big yen intervention. We begin this hour with tech stocks adding to gains following strong earnings from Amazon, building on Microsoft's record one-day value gain. Dan Greenhaus of Solus writing the following. The economy is doing well and earnings season is going great. It is the macro that seems to be confounding investors. Dan joins us now for more. Dan, welcome to the programme. Every time we get earnings from MasterCard and Visa, I think of you, buddy, and I think of the economy that seems to be doing OK. Dan, is there a decent argument just to sit here going into the weekend and say things are all right?
I think things are definitely all right, and it's thank you for thinking of me, but it's not just MasterCard and Visa. It's Brunswick. It's a whole host of other companies, American Express, another card company. It's Corning and a whole host of companies in the tech space that are talking about demand. It's Hilton and some of the hotels. I'm trying to find some corporate commentary that says things are not great, and the best you can find is that a couple of companies here or there say things are flat. That's pretty good to me. So, yeah, I think going into the weekend, you have to feel pretty good about what earnings season has done, even outside of AI. But as my quote says, the commentary from the Federal Reserve obviously has given a lot of people some indigestion.
We are learning something about price, positioning and leverage. Dan, what have you learned about price, positioning and leverage over the last few weeks?
I don't think I've learned something, but the idea that it's easy to run a $20 billion hedge fund has probably again been challenged. Listen, I don't want to comment on the specifics of the situation since obviously I don't know them, but running money is about more than just being levered long something that's in a bull market. It takes patience and diligence, and it's called a hedge fund for a reason. And apparently right now there's a washout. This happens from time to time. We've all seen it in our careers. I don't know whether it's over or not, but the action certainly feels like the worst of it may be behind us.
But there's a larger question here, and what John's getting at is how much leverage is still in the system and needs to get washed out, right? I mean, in other words, is this emblematic of a whole host of other funds or other types of activity that replicate this in a time where some people have gotten used to markets only going in one direction?
Yeah, listen, some of these charts are obnoxiously vertical. You guys talk about it. We've talked about it. And a lot of them have corrected. And I imagine there's a lot of people who run smaller amounts of money so they don't make it into the journal, let's say, who are being, as we say, scientifically blown up. And I imagine there's a bunch of them on the smaller side of things. I have no way to quantify that. You can bring on someone from the prime desks from the big banks and they'll have more color than I do. But it shouldn't be surprising. On the way up, we all talked about that this was unsustainable. We would pull up charts of SanDisk and AMD and Micron, et cetera, et cetera. And I would say you don't need a PhD, you don't need to be a technician to look at these charts and know that it's not going to continue. And obviously that has, to some degree, stopped over the last couple of weeks. I would just say, getting back to my point about corporate commentary, again, when you read through what these companies are actually saying from Google on down, there's no cessation of demand. You haven't really seen anyone talk about any equation between supply and demand. It's all, we're still going full bore here. So I think from a cycle standpoint, you still have to be encouraged by what's going on.
Do you think the pendulum is still squarely on the equity markets for relative value right now, given how much yields have backed up, even in a pretty good time for consumer credit?
Yeah, well, we've talked about this in the past. I think, and to turn this to the Federal Reserve for a second, we're all, including Chair Walsh, are trying to figure out why yields are going up. And obviously there was I think John called it a freak out after the press conference. So I think that we all don't really know why yields are going up, and we're trying to figure it out here. And I think that speaks a lot to what happened the other day.
Do you think it's fair to say he's part of the reason yields are now going up, Dan?
Well, sure, yeah, it's undeniable he's part of the reason that yields are going up. I think to have fun and be a contrarian for a second here, I understand what he's trying to say, maybe to a better degree, or maybe I heard something other people didn't hear. I heard he was too vague at points, fair, but I heard a guy saying we need to make sure that we're measuring this stuff right. We need to make sure that we understand why it's going up and whether or not interest rates are the correct way to combat the rise in inflation if it's going up according to whatever new way we might measure it. And I think I heard a guy just repeatedly ask for patience, and the market obviously does not want to give him any.
Is there some sort of 4D chess going on with what's going on with the press conference, what we saw in yields, and then the New York Fed doing a rate check for the Bank of Japan as there was some intervention over there? I'm just wondering if there's correlation or any kind of relationship between any of these events.
As a general rule, I don't think anyone is ever playing 4D chess. So I would say no to that. I think we're going through a transition here where the new chairman of the Federal Reserve is trying to move away from what he believes is an era where the Fed provided too much information to an era where perhaps the market has decided the Fed is providing not enough information. And that transition is coming with volatility, completely unsurprisingly. That process is going to go on for a little bit. I don't know what the outcome is going to be. I don't know who's going to win that debate, quote unquote. But I think that's really all that's going on here. I don't think there's any new spike in underlying demand that would push up inflation. Obviously, oil prices are volatile, up $4 one day, down $5 the next day. And I think, again, we're just trying to figure out why inflation is going up. And more importantly, again, he said this, are interest rates the best tool, the only tool to combat what's going on? And again, I just heard a guy asking for some patience while he figures it out.
Dan, I had that question too on the balance sheet, which is what you're alluding to. And I think this is important. If you have a Fed chair that is refusing to articulate a reaction function, and in some ways communicating he's not in a rush to hike interest rates or use that tool at all, if I'm in the market right now and I'm thinking, where is there flexibility to express a view across the curve right now? The last place I'd do it is the front end of the curve, because that's where the Fed can actually anchor things. So if you've got a guy suffering from inertia, I don't know, describe it, characterize it, however which way you want to, that 2 years is going to remain anchored somewhere close to the policy rate. It's about 50 basis points away. The flexibility is further out along the curve, which is how the market expressed the view on Wednesday to push yields higher. So, Dan, I think we can sort of think about the yield curve that way. That's where the flexibility is. That's where I can push this market round just a little bit. So, Dan, we've got to think about, OK, what do higher long-end yields mean to markets cross-asset if front-end rates will remain anchored? Now, one way of expressing that cross-asset is to go short the US dollar. We saw that on Wednesday. I just wonder what it means to you, Dan, if that's just a base case assumption for the next several months.
So getting back, I said a couple of times we're trying to figure out, I kept saying why inflation is going up, but the answer tangentially is why yields are going up. As an investor, in credit, obviously you care about spread, and in equity you care about relative value, among other things. So one thing we've all discussed is how much is the demand for capital from the hyperscalers and from tech in general, and is that pushing up yields, et cetera, et cetera. If something like that is what's going on, then that's more or less a positive. And I think it speaks to, despite the freak out that's happened at the very long end of the curve with the 30-year, let's say, but even the 10-year at 470 is at elevated levels, you still have the S&P basically at highs. It's up 9% for the year, give or take. Half the index is up more than the headline, which is about what you would expect. It's not as if it's top heavy and AMD and Micron are doing all the work, so you have half the index up more. So broadly speaking, the economy thus far and the market thus far is doing kind of what you would hope, even with this backup in yield. So in terms of I as an investor, or we as an investor class, how do we think about it? If what's going on here is the economy is doing fine, earnings are doing fine, and again, virtually every company is bearing that out, then I'm far less concerned about the backup in yields, assuming it's orderly.
Dan, appreciate it, buddy. It's good to see you in the studio next time. Dan Greenhaus there, a Solus Alternative Asset Management. Dan, thank you. It's the recipe for higher long-end rates, isn't it? If you take the emphasis off short rates, as a consequence, you're putting the emphasis on long rates. If you're flagging with balance sheet reduction at the same time against the backdrop of increasing supply absolutely everywhere, that's even more pressure for higher long-end rates.
Yeah, and that's how you're seeing it transmitted through the market. A real question here, though, what is the most effective way to tighten financial conditions? Is it on the long end or is it on the short end? Some people would argue the purest play is on the short end because it takes the leverage out of the system, and it might not be a coincidence that Citadel put out there that they expected the Fed to hike rates this week right before. I mean, well, this is something people have been talking about. Look, I'm not saying that that is actually what happened.
You're just asking.
But I'm just asking.
Of course, many others are too. 425 on twos, 10s around 467, 30s of 520. With an update on news worldwide with your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. The Kospi surging by a record 18%, driven in large part by the chip makers. SK Hynix rallying by the 30% limit, and Samsung up 27% intraday. Bullish reports on the AI build-out overseas, regulatory support from the South Korean government among drivers of today's rally. Microsoft soaring 16% in Thursday's trading for its best one-day performance in 18 years following strong earnings. The company adding nearly $500 billion to its cap, the most by any stock in any single day. The Spanish government ordering troops to one of its two North African enclaves after a recent surge in illegal immigrants. The migration crisis risks a flare-up in tensions with leaders across Europe. Italy's Prime Minister, Giorgia Meloni, threatening to impose travel restrictions on Spain. And that is your Bloomberg brief. John.
And Vonnie, thank you. Watch this space. That is a major, major point of tension for Europe right now. Up next on the programme, we've got a breakthrough in Gaza.
The war in Gaza, which proceeds at a very low level, it's just about there.
The war in Gaza is over. It's over. There are little flames. Hamas has been, I think they're going to give up their weapons.
Up next, General Robert Walsh of Academy Securities, live from New York City this morning. Good morning. Mike Worth, Chevron, crushed it. Good morning. Stock is up in the pre-market by 1.7% higher year to date by more than 20. I think 26 percentage points higher. The earnings come in as follow. The biggest quarterly profit we've seen, Bramo, since 22.
Yeah, when you take a look at the overall earnings per share in the second quarter of $6.06 versus an estimate of $5.65. Just taking a look at what they're doing with some of this profitability, they're paying down debt. This is fascinating. They're increasing production. They had about a 20% increase in production over the period of time, and it's running its U.S. refineries almost full out with the utilization rate above 97%. So this is a company that is taking this moment to sort of fortify its balance sheet, be prepared for whatever is coming next, but might not have the conviction to go in and do new exploration and drilling, because ultimately it is a cycle, and typically when you get that kind of cycle, prices can come down pretty significantly if they go to heights that we've seen recently.
We've seen this in energy, we've seen it in mining. After the bust of the last decade or so, in both asset classes, for both the metals and for oil, I think of the shale patch, of course, more recently for the oil majors, it was a focus away from volume to value. Capital returns over investment. It's not to say they don't make massive investments, they do, but certainly the emphasis has shifted since then. And if you're a company like that, are you going to make a long-term call off a short-term volatile move? That's a difficult call to make.
Which is why they're paying down debt and fortifying their balance sheet. Notably, Chevron shares up 23% so far this year. Sounds really good. Up only 3% since the war in the Middle East started. So a lot of investors have been looking through this and saying, okay, what about the other side? How are you going to grow, et cetera? Right now, they're growing just by simply profitability and their balance sheet getting fortified.
Add a few percentage points to that move this morning, up another 2 in the pre-market. Equity futures shaping up as follows. Up by 0.5 on the S&P 500, up by 1 percentage point on the Nasdaq yesterday, 3% plus gain on the Nasdaq 100. Biggest one-day gain we've seen for the year so far, going back to March, which is quite a gain for the Nasdaq because it's been very volatile over that period. On the Russell this morning, up by 0.5. In the bond market, 2s, 10s and 30s shaping up as follows. Someone's got a new mug on the desk. 2s at 425, 10s at 467, 30s at 520. You want to share it with the audience,
I walked in to Yield is Destiny.
Yield is
and
Destiny.
It's not just Yield is Destiny on any mug. It's on an inspirational, spiritual mug.
I like the tone as well.
It gives you a sense of being on vacation.
How quickly did our cameraman Marlon move to get that done?
Marlon, you are an absolute champ.
Pretty impressive, isn't it?
I am inspired, and I plan on going for a walk this morning.
Are you going to, produce some and sell them?
Let's see how today goes.
A little bit of Bramo merch.
A little merch.
I'll take some
Bramo
merch.
All right, well, we'll see if we can make that happen.
See if we can sell some mugs, not just some bonds. 30-year yields, 520, maybe to some mugs. Anyway, let's turn to the commodity market. Brent WTI shaping up as follows. That was a bad dad joke. Brent crude around 90, we're up by 0.6%. WTI 84, up by 0.5. Under surveillance this morning, a breakthrough in Gaza.
We reached a momentous breakthrough in the Middle East, something that people said was never going to be done. The war in Gaza, which proceeds at a very low level, it's just about there. The war in Gaza is over. It's over. There are little flames. Hamas has been, I think they're going to give up their weapons.
So here's the latest this morning. President Donald Trump saying the Board of Peace reached an agreement to disarm Hamas. Questions remain over the details and the implementation of the deal. With the latest, Tyler Kendall has more. Hey, Tyler.
Hey, John, good morning. Well, if this agreement holds up, it would be incredibly significant for that 20-point peace plan to resolve the conflict in Gaza after months of little progress. But you're right. At this point, it's unclear exactly how this will work. The deal does hinge on Hamas giving up its arms, with a senior Israeli official telling Bloomberg News that Israel is demanding the full demilitarization of the Gaza Strip. That will then kick in a phased plan where Israel will withdraw its forces as well. Now, Hamas, a terrorist group designated by the U.S., has said that it did agree to a deal, but leadership from the group told Al Jazeera in an interview overnight that it's not going to take any steps unless Israel withdraws its forces first. So it appears that there may be a sequencing difference here between the two sides. We'll have to see how it goes from here. U.S. officials are saying that they still need time to refine some of the details, and they're going to give a 200 to 350-day period for it to be implemented, also deploying what's being called an international stabilization force in order to ensure everyone's safety. John, very quickly, of course, any potential resolution has broader implications for the region, since Hamas is a proxy group backed by Iran.
Tyler Kendall with the latest down in Washington. Tyler, thank you. To build on that, joining us now, General Robert Walsh of Academy Securities. General, welcome back to the programme, sir. Is this situation now more dangerous than it was 4 or 5 months ago?
I think overall the situation in Iran has gotten much more dangerous, but I think the last piece that Tyler added, the piece on Gaza, makes it very significant that the larger Middle East peace plan, the Hamas disarmament agreement, which will take some time, is a big step in that. It's another step in isolating Iran. And what we're seeing throughout the Middle East, more and more of these pieces are coming into place that is isolating Iran more and more. This was a case where the IRGC asked Hamas to delay this decision and not continue with it. And in fact, Hamas went against this and agreed to the disarmament. Now, the devil's in the details, and we'll see where it goes. But this is a step in that direction. And the larger question is the situation with Iran getting more dangerous. It obviously is, in the sense that we've gone from a phase of really deterrence where a ceasefire was in place. We've kind of gone back and forth where these attacks between Iran and the U.S. have been occurring. But now what you're seeing is Iran again using their asymmetric capabilities to try to spread the fight and extend this throughout the region by bringing in the Houthis into it, bringing in the Shia Iraq militias into it, attacking the Saudi Arabia oil fields. So a little bit of a widening going on here, and that's Iran's asymmetric approach, is to try to widen the war, put more pressure on the U.S. and the U.S.'s partners in the region.
General, what do you think the next steps will be for the U.S. and its regional partners as the war does broaden out more significantly?
It's a great question, Lisa. I think the president has a lot of options on the table right now. I think the president's desires to get back to getting a deal. He continues to say that over and over. And you saw where we had this 13-day significant escalation by the U.S. And this was now for the first time, instead of a tit-for-tat approach, the U.S. used a disproportionate approach, where if Iran hit us with 3 missiles, we went back and hit them with, hundreds of attacks on targets throughout the Gulf region, or throughout Iran. But with that, now that what we're seeing is that the president again kind of settled things down, stopped those attacks to see if negotiations could continue. And I think the options he's got now is, one that Admiral Cooper has on the plate is to go much larger and really try to increase the number of attacks more along the ways of what we were doing earlier in the war. But again, really trying to isolate the Strait of Hormuz by attacking, command and control facilities, drone and missile capabilities that can strike the Straits of Hormuz. That would probably be a phase 1 approach. See how that goes. And if you can get Iran to kind of back off and try to, push their will to the point where they want to get back to the negotiating table, get to a ceasefire, that would be a step. If that doesn't work, I think another option on the table is to go really big, and that would be to try to isolate the country itself, to really significantly go after, probably bringing in Israel, go after infrastructure targets throughout the region.
We all hope we can make some progress on the diplomatic front, and it doesn't come to that, sir. General, appreciate your time. Thanks for sharing some of your morning with us. That was General Robert Walsh of Academy Securities. Up next on the programme, Tom Forte of Maxim Group, as Apple sinks on supply shortages. That stock is down 7%. Stocks this morning positive heading into the weekend on a high note, up by 0.5 on the S&P, up by 1.2 on the Nasdaq 100. The Nasdaq 100 bouncing 3% in yesterday's session, best day since March, following the longest slide on the Nasdaq 100 since October 2022. That's the index level story this morning. Flying in South Korea. That stuff is crazy. We'll spend some time on that later this hour. In the bond market, 2s, 10s and 30s, things have been crazy here as well. It's nuts. Think about the amount of ink that's been spent dissing Kevin Walsh in the last 48 hours. I'm not saying it wasn't well spent. I'm sure it sold a lot of papers. I'm just saying that the 30-year, the yield has barely budged on a week. We've had a move of like mid-low single digits on a 30-year yield. 520. 520 this morning.
He triggered a lot of people, but it didn't actually leave a pretty big scar on the market, at least for now. And possibly it's because people are waiting for more information. And after momentarily feeling a very emotional response to this change, and change is tough, and I get that. But, after that, I think people have reset and understood, we still don't know a lot, and I guess we have to be patient.
You're not giving yourself enough credit. This is not about change. I know, and I've worked with you for a decade plus. You're not pro-establishment. You're open to change. You're open-minded about all of this, going through the process. You're certainly not afraid of volatility. I know you welcome it. This isn't about any of that.
No.
This is about the tone. It's about how patronising the news conference was for people who have followed so many of these issues for a long, long time. He sounded like a man who hasn't worked for 15 years. Stepped into the room and decided that no one else knew anything. That's what the news conference sounded like on Wednesday.
We're going to discuss big issues like what's the cause of inflation? What is the correct measure of some of these metrics? How should we look at it? We've been debating this. I mean, the market's been hashing this out, and frankly, it's been a wonderful family fight, and it's been really enjoyable to cover it. I think that the key question is this a Kevin Walsh that is trying deliberately to mislead or just somehow just gaslight a group of people, or is this somebody who genuinely is exploring these issues and not communicating it properly in a way that actually resonates with people?
Don't know, and we certainly want to give him a chance.
Totally.
Don't know, but that tone's not going to help, that's for sure, on Wednesday. And I think that's what a lot of Wall Street had a problem with. It's not about the market doing the work and the end of the hand-holding. I don't know anyone that's really too bothered about that. In fact, how many people in the market have been sick to death of this Federal Reserve for a long, long time? Yield is destiny.
Yield is destiny, and we have yield. So many bond investors are thrilled.
They've been complaining about it for years.
Financial repression has been death to active managers in the fixed income area. So yes, hallelujah. Do we want the Fed repressing, dynamic markets? Absolutely not. I think it's just a matter of exploring it openly and honestly.
Well said. Okay, let's move on. 3 hours away from the cash open. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. Apple's safe haven status is taking a hit this morning. Shares down 7.3% after the company issued a disappointing forecast, warning us that the problems we've been talking about repeatedly, higher memory costs, component shortages, will weigh on growth this quarter. Add to that a miss on its high-margin services business and China sales, and you get the reaction you're seeing today. Of course, shares had run up more than 20% year-to-date heading into the report as investors rotated away from those big AI spenders. But this morning, one of those big AI spenders is getting rewarded, and that is Amazon, up nearly 13% in the pre-market because investors got exactly what they wanted, assurance that the company's massive AI investments are paying off, even after it raised capex plans from $200 to $220 billion. And that was okay because AWS, the leader in cloud, grew at its fastest pace in nearly 4 years. And we get a bunch of energy earnings out this morning. And the first one is Chevron, which you broke earlier. Shares up 3.25% after the company delivered one of its strongest quarters in years, of course, boosted by higher energy prices. It easily beat expectations, but the story goes beyond that. Chevron also increased production 20%, cut debt by a record $8.4 billion, and boosted share buyback, showing that it's using this period of elevated energy prices to strengthen its business. John?
Yahara, thank you. More from Yahara in the next hour. On our radar this morning, South Korea's Kospi surging, rising by a record 18% in today's session. The rebound fueled by chip heavyweights SK Hynix and Samsung following strong US tech earnings. Elsewhere, Amazon shares soaring, the company reporting a fifth straight quarter of cloud sales growth with a 37% revenue jump for AWS. Apple shares sliding, the tech giant's forecast disappointing as it faces major supply constraints. And finally, Ken Griffin's Citadel snapping up the bulk of hedge funds situational awareness's AI stock bets. The embattled firm forced to liquidate public equities, selling off a heavy chunk of its portfolio following the recent tech rout.
This is Wall Street cinema. Let's just really play this out. This was at one point reportedly a $45 billion fund led by a 24-year-old AI genius who had graduated college at 19 as valedictorian of Columbia. And he believed that he had the situational awareness of AI and the incredible power that it had. And essentially, they might be right on exactly the direction, but wrong on market activity that takes the experience of one Ken Griffin, who Cliff Astis once said, when he heard him calling to bail him out of something, I heard the Grim Reaper's scythe knocking at my door, and I just kept walking towards the light, and I tried to walk away.
We're learning about the difference between being a impressive thought leader and being a great risk manager. That you can get the trade right, add too much leverage, and things are going great, they're going better, and all of a sudden, and the real lesson here for the hedge fund industry, and Dan Greenhaus was talking about, and he's absolutely right, I couldn't do that job. A lot of people struggle to do that job, and this is an example of struggling to do that job, even though you've got for the year so far, for the bulk of the year, the right trade on. You're long hardware, you're short software, but you added too much leverage and the trade started to go against you, and things have turned really quickly in the space of, what, a month?
Yeah.
That's not much time at all.
So, and I couldn't do it either. I'm here. I mean, honestly, if these people are billionaires and do very well because they are incredibly talented at doing this, it's a perfect analog to this moment. The idea of a 24-year-old idealistic, effective altruism believer coming out, having this gorgeous view, and then having sort of a grizzled pro in the market be able to come out and be like,
this is my turf.
Yeah, no, try again.
I'm not betting against the guy, the 24-year-old.
No, not at all.
I imagine he's still got a great future. He's going to take some big bets and he's going to keep swinging. I have no doubt about that.
Sometimes the people who fail the biggest are the ones who succeed the most.
Yeah, and I think there's some lessons learned from a lot of pain over the years for Ken Griffin and Citadel. We'll turn back to earnings. Let's talk about it. Apple falling in the pre-market as supply shortages cloud the company's forecast. Tom Forte of Maxim Group maintaining a buy rating on the stock with a price target of $350, writing, while the company appears to be managing the situation admirably, it looks like memory inflation is starting to impact margins. Tom joins us now for more. Tom, welcome to the programme. Is that another way of saying we've reached the limits of consumer price tolerance and that they can't put up prices anymore?
Sure. So thank you, Jonathan. So Apple did talk about its willingness to raise price to combat inflation, especially in the cost of memory. And I think that the good news is that the company does have the ability to raise price. I think really what happened here is that, to put it about as positively as we can, for 2/3 of their sales, iPhones, Macs, iPads, demand far exceeded supply. And even with Tim Cook's strength in supply chain, he was not able to manage this excessive demand. And now we've got to a point where their inventory needs to be refreshed at materially higher component costs. And that's what I think you're seeing in the margin outlook for the September quarter. And then when you couple in that 250 basis point drag from unfavorable FX, that's what you see in the weak sales guidance for the September quarter.
Tom, given you believe they retain pricing power, the question I'm trying to ask is how concerned should I be over the long term about margins so long as they retain that pricing power?
Yeah, you should not. So I think that I think what we're seeing here is the hyperscalers leading a massive round of CapEx, which is contributing to supply shortages and inflation in component costs. This will resolve itself over time. Apple is still amazing at managing the supply chain. And I would say that this is a short-term issue, but in this case, short-term could be 12 to 18 months, but it'll eventually take care of itself.
Tim Cook talked about the memory cost issue as a 100-year flood in their inability to prepare for it, the idea that nobody can really prepare for it. I just wonder, though, how concerning it is that you saw underperformance in the China business, considering that that was one area of substantial growth going forward.
So underperformance, yes, to the extent that they had growth that was in line with expectations, Lisa. I think what we're seeing, though, is that Tim is handing off a successful China business to John Ternus, to the extent that you now have had 3 consecutive quarters of 15 to 20% top line growth. And prior to that, you had about 3 years of underperformance. And the company is working on, though I do think this is going to take some time, getting that enhanced Siri approved by China regulators. So I think that directionally, he's handing off a strong China business to his successor, John Ternus, who takes over on September 1st.
What's going to be the main product of Apple in, say, 5 years? The John Ternus Apple going forward. Is it still going to be the iPhone? Is it going to be glasses? Is it going to be the watch? Is there some other device that's going to go in our heads that we aren't aware of yet?
On a percent of sales basis, the iPhone certainly seems like that'll be the one. I like your implanted product. I don't know if we're ready to have even an Apple product directly implanted into our brains. But I do think that You also hit on what I would call the low-hanging fruit. I anticipate that they'll come out with smart glasses. As you know, Jonathan and Lisa, I'm wearing my Amazon Echo frames right now. Meta's done very well in that category, and I think that's an opportunity. Foldable iPhones, I think, is another form factor that makes a lot of sense. But I am hopeful and will be closely watching if John Ternus can, mimic Steve Jobs or, channel his inner Steve Jobs and come up with that device that we don't know about yet or haven't really thought about. That'll be a next great consumer electronics device. And that's something I'll be monitoring closely.
Tom, in the meantime, what are your thoughts about how we pay for that device? If you go to, say, a telecom communications company in this country, you can walk into an AT&T or Verizon, they'll give you a good deal. In some cases, they'll just give you the phone. And you won't really be able to identify how much you've paid for that unit. What about the lease program? What does it mean for the outlook for unit sales growth?
So I was thinking about the lease program. And Jonathan, really, it's already a lease program in some regards, to the extent that you have consumers, as you pointed out, either getting very significant subsidies for their carrier or already paying essentially a monthly bill, in this case to their carrier, to have an iPhone for an extended period of time with the expectation that they'll trade in that iPhone for the next generation one. So I'd say they almost have like a de facto lease program. The difference, I think, that I learned yesterday is at this point in time, it's only in the US, and this point in time, it's only through the retail channel, meaning the Apple stores. So maybe to the extent that this drives incremental revenue iPhone sales through the Apple stores, that could be incrementally beneficial. But I would say that they've had a de facto lease program in place for some time.
That makes sense. Tom, appreciate it. Thank you, sir. Tom Forte there of Maxim Group. On Apple, that stock is down this morning by some 7% in the pre-market. It was up big time into this, largely because it wasn't a hyperscaler. And now you start to think about the growth. He says you shouldn't worry about the margins. They've still got pricing power. We'll work through. What does he call it? A once-in-a-century flood over at Apple?
Yeah, a 100-year flood in terms of just the memory cost issues. You raise a great question, though, about leasing, because you don't notice that you're paying $200, $300 more if you're leasing something. And a lot of people who have the ability to pay and aren't paycheck to paycheck are fine with that, especially for a luxury device. And that's one way to lift margins and keep them there.
Not new, though. It's been a story for a long time with that company, to Tom's point. The Nasdaq this morning up by 1.2% on the Nasdaq 100. With an update on news worldwide with your Bloomberg Brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Exxon reporting second quarter earnings that just missed analyst estimates. The company saying it had the highest upstream production in more than 2 decades, excluding the Middle East disruptions. China's DeepSeek is planning a massive AI data center in Inner Mongolia. Sources telling us here at Bloomberg the facility will add 1 gigawatt worth of compute. DeepSeek is pushing to bring at least part of its data center's capacity online by the next year or early 2028. Tesla reportedly considering the sale of its China unit. The Wall Street Journal is reporting Elon Musk is weighing that sale ahead of a potential SpaceX merger. Musk saying on X, though, that the report is fake news, while a company representative called it false information. And that is your Bloomberg Brief. John.
Right before it happens. Vonnie, thank you.
Always.
I'm tracking that reporting and, of course, the company's reaction to it as well. Just logically taking a step back, whatever you believe is and isn't happening right now. Let's just take what they're saying as sort of the base case assumption. Tesla's right, I'm listening to that statement, okay. But doesn't it make sense intuitively that that is what you would do if that's what you wanted to do down the road?
If you want to have a company that's integral in artificial intelligence as well as telecommunications and all things satellites, you probably want to isolate it from China as much as possible, especially because the Tesla business is so integral to the Chinese ecosystem of electric vehicles.
Just some of that is going to be very difficult to unpack, I'm sure. Up next on the programme, we'll talk about Japan propping up the Japanese yen.
The Japanese yen seems very undervalued to me. The currency is very cheap. The economy is doing well at a point that the market will realize the yen is undervalued and should strengthen.
Why is it in America's interest to support the Japanese yen? We'll have that conversation next. Terry Wizman of Macquarie, live from New York City. You're watching Bloomberg Surveillance. Stocks bouncing into the weekend. The bounce continues, adding to yesterday's gains. Futures higher by 0.5% on the S&P. We'll round it up on the Nasdaq, up by 1.2. In the bond market, 2s, 10s and 30s. Things have settled down. 2s unchanged around 425. 10s around 467. 30s around 520. Under surveillance this morning, propping up the Japanese yen.
The Japanese yen seems very undervalued to me. The currency is very cheap. The economy is doing well. The prime minister is very popular and enacting very strong policies. And I think we're going to see the fundamentals come through at a point that the market will realize the yen is undervalued and should strengthen.
So here's the latest this morning. The Bank of Japan keeping rates on hold after reportedly intervening in the FX market. The Trump administration adding to support the yen. A market participant telling us here at Bloomberg, US officials conducted a rate check ahead of the BOJ's rate decision. Terry Wizman of Macquarie joins us now for more. Terry, good morning. Good to see you.
Good morning, John.
Can we start here? Why is it in America's interest to support Japan as they face this problem? I won't say crisis, but certainly growing problem.
Yeah, I mean, this is a great question. You would think that a market-oriented White House, a market-oriented government would let the market settle where it wants exchange rates to be. But this is not the White House that we have been dealing with for the last year and a half. This is a White House that sees, I think to some extent, conspiracies around the world. And when it sees a foreign currency depreciating a lot, it feels that the United States is being slighted. Our manufacturers are being slighted. We've seen that with China. We've seen it with Korea in the past, and the comments the White House has made. There is this issue and this feeling that weak currencies abroad are detrimental for our workers. To some extent, that is true. And I think this White House has their interest in mind to some extent, for political reasons, mind you, and it has to demonstrate that it's not going to let competitiveness in the U.S. Erode indefinitely. So that's the interest that the U.S., I think, has. It's political, it's domestic, but it's an interest nonetheless.
Japan has a solution. We were talking about it. The BOJ can hike. The BOJ chose not to. I'm trying to understand why they keep choosing not to.
Yeah, well, first of all, the hikes that they've done in the past 2 years have not really helped the yen situation. Let's keep that in mind. They have been hiking, and yet the market has been speculating against the yen, against the yen, against the yen for the last 2 years, to the point that we got to dollar yen at 165. So you could say, yes, they could have hiked as a solution to this. I know they didn't. But it's not clear that that would have helped by itself. I think the proper solution here might have, or at least the solution they fell upon, was to have the MOF, the Ministry of Finance, do the intervention, and then have the BOJ come out, not hike, because I think that would have been too much of a shock to the market. Remember, there were too many traders out there who are short the yen and using that short position to finance other currencies, and you would have caused a lot of volatility by a sudden unwinding, a shock unwinding of those positions. But to at least to prepare the market for a hike that's coming, I think this is proper. So we used to think, you go back a month, the market thought that the BOJ was going to hike in December. And then there was rumors in the last week and a half that said they were going to accelerate that hike. And then people started to think it was going to be October. Now it seems like it's going to be September. And the emergency, if there is one, is that the dollar yen pressed to 165. Importers in Japan were getting hurt. Takaichi's popularity ratings were falling over the last 6 weeks, in part because of the cost of living issue in Japan, which had been highlighted by the press. And at that point, the MOF, which is an arm of the government, decided it needed to do something.
Maybe this is a step too far, but I'm wondering if there's a bigger takeaway from some of the central bank events this week, and that is that a lot of these central bankers are leaning on the long end to do the work, and they seem deeply reluctant to make a move on the front end as quickly as some people are suggesting might be necessary, and allowing yields maybe to go where they naturally would otherwise go. What do you make of this?
Well, so there's definitely a debate in the market as to how to interpret the backup in yields at the long end. Not everyone believes that it has something to do with long-term inflation expectations. A lot of people out there believe that it has to do with the fact that governments around the world, government borrowers, sovereign borrowers, have just a lot of debt, and it's way about time that we started to price that in properly, and the market is driving yields higher to reflect that sovereign credit issue, that debt sustainability issue. There's another view out there that really talks about inflation as the problem, and the fact that the central banks have not been quick enough to address the inflation issue. I think that probably is more the issue in the U.S. than it is in Japan. Of course, we have a Federal Reserve that has not, in the past week, gotten around to signaling strongly that it wants to address that inflation issue. And as a result, you saw yields back up further on Wednesday. That's a problem, too. But at the core of the issue is this debate. Are long yields going up because of government debt, or are they going up because inflation expectations over the long term have been going up?
And where do you stand on that?
It could very well be a combination of both. We don't have to fall on one side or the issue, and it may be country specific. In the U.S., you don't see inflation break-evens rising that much, but you do see survey-based inflation going up, and the Fed has cited that as well. And certainly a lot of people at the Fed have cited that. I would say that in the U.S., it's clearly more of an inflation issue than it is a debt issue or a debt sustainability issue. In Japan, it might be more of a debt sustainability issue.
Everyone's sharing their movie review. What was your review of the news conference on Wednesday?
Oh, absolutely terrible. I mean, we were giggling on the desk.
Were you really?
Yeah, absolutely. We did not hold back. I certainly did not hold back in the notes that I wrote.
What was it that made it so terrible?
Look, there were three potential reasons for why it went as badly as it did. I'll review them, really quickly here. One of them is that, Chairman Walsh is really a dove at heart. I mean, he's a structural dove. He got the job for that reason. And all of this is just a veiled way of delaying the rate hike, right? And the way you do it is you just talk and talk and talk until you exasperate everyone or get them, confused enough so that maybe they don't pressure you to hike. That has not worked that well with respect to the other members of the committee. They have coming out before the blackout period and basically telling you that it's time to hike. And you saw that with respect to the dissent. The second theory is that he's just over-intellectualizing the whole thing, right? Sometimes, let's admit, too much brain power is counterproductive, right? It just is. And, but the problem, of course, is that this is the Federal Reserve. And the Federal Reserve has to confront crises from time to time, not just high inflation. You don't want Hamlet at the head of the Fed when there's a crisis, okay? But this is a second theory, that there's just too much brain power at work here. The third theory is he just doesn't trust anyone, right? And that's revealed by the fact that he needs these task forces to tell him what the inflation framework should be and how the Fed should address it. My view is, what the heck are all those 200 economists doing on the staff of the Fed? What is the FOMC supposed to do? Aren't they your task force? And this lack of trust was revealed, I think, in the presser the other day, because he said, when he was asked about who was on this task force, he said, these are people I've known for a long time.
Yeah.
Well, does that mean they're your friends? And what's the point? I mean, isn't the task force supposed to be independent? Isn't it supposed to give you an objective opinion? I would have rather heard him say, these are not my friends. These are people I've never heard of. Right? That makes more sense.
We should have started here and not done.
Anyway, those are my three theories. I tend to fall on, along the view that he's a structural dove, and this is the reason why this has happened.
Terry, appreciate it.
My pleasure.
Thank you. Terry Wizman there of Macquarie. Up next on the programme, Victoria Fernandez of Crossmark, Daleep Singh of PGIM, Lei Chu of AllianceBernstein, and the Aries CEO, Mike Arougheti.
The rest of the market cannot play the ball without knowing how the Fed might play the ball.
Some real anger at the long end of the curve.
If yields rise too much, it's going to break something.
This has become a lot more about credibility than actually bringing inflation down.
I think we'll get to a good equilibrium eventually.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your price action scores look like this. Equity futures adding to yesterday's gains. We're positive by 0.5 on the S&P. On the Nasdaq, the biggest one-day gain since March. We add to it by 1.2% on the Nasdaq 100. On steroids, that was the rally over in South Korea earlier on today. Check it out. The Kospi, not a typo, up 18% on the session. The session. This is intraday. Not month to date, year to date. Samsung up by 21%, SK Hynix up by 26%, and even with that move on the Kospi, it's just unreal. We're down on the week in South Korea.
So is this enough to give people confidence, or is this just more whipsaw volatility? And I ask this in the frame of reference of some sort of washout of leverage. We're seeing that with respect to Korean officials coming out cracking down on retail leveraged ETFs. We see this with the unwind of a big levered U.S. fund tied to technology. And there's a question here. Are we seeing some of the bottoms because of the washout here? Or does this just indicate how much is left in the system?
So it's been a thing for us for what? The last month, the last 2 months. We've learned tons about price and positioning. We've talked about it extensively. Learned lots about leverage in South Korea. Talked about that extensively. I don't think you should overlook the fundamentals, though. We should talk about the fundamentals. How sustainable is the spend? Everyone's still ramping CapEx. Some companies are punished for it. I'm thinking of Tesla, I'm thinking of Alphabet. Others rewarded for it because the gains elsewhere are so good. Thinking this week of, say, Microsoft. But you've started to see something you pointed out very early on last week with Alphabet. They've got negative free cash flow. They're becoming increasingly, I'm not going to say dependent, but increasingly dependent on raising capital from elsewhere to fund this CapEx. And the price of that capital is going one way at the moment. It's going up. You've seen spreads widen in credit and you're seeing yields climb on treasuries. If that's the direction of travel, more questions will be asked about the ROI and how expensive the spending is becoming.
This is why I find the Amazon move so interesting. They also outperformed with their cloud computing service, the AWS, and that's the reason why their shares are absolutely surging in pre-market trading. They raised their CapEx to $220 billion from $200, and they were negative cash flow. Free negative cash flow, and that wasn't something they were penalized for. So it's unclear how this story is coming together and how much tolerance there is. You can feel that ambiguity when you speak to fund managers and we speak to people in the industry who say this technology is real. There still is a whole host of infrastructure that needs to get built out. The promise is there. It's just about who the winners and losers are going to be.
You've got to communicate the path with tons of clarity and with decisiveness and show the numbers, the hard numbers, the growth. Probably the difference in the last week between the companies that have done well and the companies that haven't. And Meta is one of the companies on the wrong side of the conversation right now. Within that company is a very profitable business. With that, there can be no debate. We know that. But when you're on a call being indecisive about what that capacity is for, you're not conveying confidence that you know where this is going and you know what the end point is. And that's going to be a problem for a lot of people.
We're out of the dreaming phase. We need the tangible phase. We need the return on investment. We need to see the business path going forward. We need the clarity of vision, because right now, clarity of vision, whether you run one of the biggest tech companies in the world or whether you run the most important central bank in the world, is what gets rewarded in markets.
That's exactly where my mind was going. I was just thinking of one guy.
Of course.
I wasn't talking about tech CEO. I was just thinking of this one guy.
I picked up what you were putting
at the Federal
down.
Reserve.
Yeah.
2s, 10s and 30s looks like this in the Treasury market this morning. Treasuries were sold. Credibility was sold. Earlier this week, on the week, things have settled down. We've settled down around 520. And the lack of clarity of this institution is a contributing factor, but not the only one, to high yields. There's a lot going on in fixed income worldwide.
Yeah, with respect to what's going on in Japan, with respect to the fact that every single major government is borrowing money and there is a huge deficit issue. What I'm curious about this morning and in the weeks ahead is how much dissent we get, how powerful some of the dissenting voices on the Fed actually are. Do we see the beginnings of a mutiny being staged where suddenly Kevin Walsh ends up in the minority?
I see some pushback on the horizon, let's put it that way. And we're all looking at the schedule as it builds out with all the Fed speaking, waiting for one name to pop up, and that's Chris Waller, Fed governor. Didn't dissent at this meeting. It was notable that we got no governors dissenting at this meeting, that it was just regional Fed presidents. There's nothing original about that. 3's a big number, I know, but it's the governors on the board. Do you start to see some building daylight between them and the man at the top?
Does Chris Waller become essentially a shadow Fed chair? And ultimately, people are watching his voice as the loudest one in the absence of a concrete voice coming from the top.
Yields up this morning by a single basis point, 2s, 425. Coming up, we'll catch up with Victoria Fernandez of Crossmark with tech rebounding, Daleep Singh of PGIM as investors question so-called Fed credibility, and the Ares CEO, Mike Arougheti, on the depth of capital markets. We begin this hour with tech stocks rising following the biggest one-day gain since March. Victoria Fernandez of Crossmark writing, earnings continue to reach new heights, even if companies are not always rewarded for it. And it's not just the large-cap stocks. Victoria joins us now for more. Victoria, welcome. We're wrapping up mega-cap earnings season. One more still to go. NVIDIA, a long, long way away. We'll get to that later on in the next month or so. But let's talk about the names we have heard from. What's been the differentiating factor between the companies that rewarded and the companies that were punished?
You know, Jonathan, you mentioned it a few moments ago, and I think it's important. It's the communication that we're getting. So we've seen negative free cash flow from multiple companies. We've seen multiple companies up the CapEx spending that they have and get punished for that. But yet we have Amazon come out and their stock is actually up. And I think it comes down to Andy Jassy on their call was very clear and concise about what they're doing, about the return that they anticipate getting through AWS with the growth that they're seeing there, saying that they see it as a $1 trillion business going forward. So I think he set expectations as to, yes, we're spending this money, but look at the returns that we're getting on it. Here's the goals that we're setting that we see. And we didn't necessarily hear that same narrative from some of the other CEOs. And so I think that's what investors are looking for. Show me exactly what is happening here and how this spending is going to improve the business, and then the stock gets rewarded. And I think that's part of the main difference, because really, all in all, earnings were pretty good across the board.
Communication should be easier to fix than a bad business model. Now, Victoria, if you've been punished because of bad communication, is there an opportunity to buy some of those names? Because underlying that is a decent business model.
Absolutely, I think there is, and I'm hoping a lot of people went in and bought Microsoft when it was down. We talked about that before, that's a great long-term holding to have in the portfolio, and I think you can be very tactical right now. There's not a lot of high correlation in sectors once you move outside of energy and utilities, so some of these names that are getting hit for reasons that maybe are something that's simple to fix, I think you can go in, you can be tactical, you can add to some of those positions. You're not maybe doing like a full position in there, but you want to add a little bit here and there as the market moves, because as we know, each day it's either up or down. I think you can go in and do some changes there that can be beneficial to the portfolio.
Victoria, just to sort of underscore what you're saying, is this essentially a market of stocks that all look pretty great and pretty successful, that are probably going to end the year somewhat higher, and that you're just essentially tactically trading within them as they sell off for various reasons?
I think that's part of the story here, especially when you're looking at tech, when you're looking at the semi names, these chip names, when you're looking at some of the memory names. There's so much volatility under the surface. I mean, you look at the VIX, and we had, an 18 handle yesterday on the VIX, but underneath the surface, there's so much movement going on. I do think you can go in there and have those tactical plays right now. Do they end the year higher than where they are? Probably, as long as we see earnings continue to hold up and that communication gets better, where shareholders feel confident about where that spending is going and what that return is going to be.
Late last year, I was talking to a number of credit investors who said the best way to play tech was to invest in their equity and avoid the credit, because ultimately you are taking all the downside and none of the upside. Has that equation shifted? Possibly as borrowing costs go higher, as yield is destiny, and destiny looks a little brighter for all those fixed income investors. Do you see the pendulum shifting in the risk reward to bonds?
I think it depends why you're investing in fixed income. If you are going into fixed income because you just want to have that steady cash flow coming out of there, and you feel confident that these companies can meet their principal and their interest payments, then why not go ahead and put some exposure in your portfolio to some of those longer dated tech names in the bond market? That makes perfect sense. But if you're going in and you're trading it more opportunistically, then you have to look at what's happening to CDS spreads. I mean, we went on some of these hyperscaler names, CDS going from around 150, 160 out to like 240, 250, huge changes in CDS spread. So if you're looking day to day at market value on fixed income, then I don't think it's where you want to be. That's going to give you a little bit of indigestion. But if you're just looking to get some cash flow, then these higher yields that you're seeing can be good for your portfolio.
Victoria, good to see you, as always. Thanks for jumping on. Victoria Fernandez there of Crossmark. On this market right now, Torsten's Lock of Apollo just published in moments ago, higher for longer continues. Why are rates so high, the highest in 20 years? We're talking about the long end of the curve. He offers 3 reasons, and he doesn't mention Kevin Walsh. Inflation, fiscal problems, hyperscaler issuance. The bottom line, we're not going back to the 2010s. It's good news for everyone cutting coupons in high-quality fixed income.
Yield is destiny. And
that was teeing you up for it, I know.
But it's true. If you want to clip coupons, well, this is a great time to do it, because your coupons look pretty darn good, especially for high-quality debt. Key question here, the inflation side of things, is mentioning Kevin Walsh without mentioning Kevin Walsh. Is it essentially allowing inflation to run hotter for a longer period of time as a result of avoiding any kind of rate hike? The fiscal problems, everyone keeps mentioning, but no one keeps delving into it. People are worried about the deficit. It's not just me. And the hyperscaler issuance, that is going to be the key, especially as these spending ambitions continue to ramp up.
You need to mass produce those mugs. You know that, right?
Evidently.
I think they would sell. I really do.
I love this. This is absolutely
trading
fantastic.
Floors everywhere.
Yield is destiny.
Without a doubt.
It would be for all the fixed income investors out there.
Think of a price, all right? Prices are going up. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. $5, $10, $10, 15?
$10?
Bonnie Quinn's got more. Hey, Bonnie.
Hey, guys. Thank you so much. Spanish Prime Minister Pedro Sanchez saying the country suffered a, quote, territorial attack. This after hundreds of migrants breached the border fences from Morocco yesterday. European Commission President Ursula von der Leyen reacting, posting on X, saying, "We cannot allow anyone to come to our union without abiding by our rules." Anthropic says its AI models breached 3 organizations during recent cybersecurity tests. In a blog post, Anthropic said it found 3 instances in which its Claude AI tool accessed the internet and then hacked into external organizations. Momentum building against FIFA's plan to bring private investment into the World Cup and other football tournaments. Sources telling us here at Bloomberg, Real Madrid and Juventus are the latest European clubs to oppose the idea. FIFA maintaining, quote, nobody is selling football. And that is your Bloomberg brief. John.
Vonnie, thank you. That's the central question in all of this. Who owns the sport and who takes the risks? I was just reading the story from Rodrigo Oruela, our colleague here at Bloomberg, on why Juventus, Real Madrid and all these clubs are starting to push back. They own the player rights, they fund the salaries, they absorb the risks associated with any injuries when they go to play at these tournaments.
They have a real vested interest in controlling some of this. Also, how much animosity, UEFA and FIFA, given the fact that FIFA has really kind of overplayed its hand in a lot of ways.
It's a sad day for football. Can I tell you why it's actually a sad day for football?
Please.
Will you give me a little bit of space?
Always.
The legendary defence of AC Milan in the late 80s, 1990s, Maldini, Costa Curta, Tassotti were led by a guy called Franco Baresi, the greatest defender that ever lived, and he passed away in the last 24 hours. So we wish him and his family and all of his friends the very best. A sad, sad day for Italian football. When everyone talks about Maldini being the greatest defender of all time, he had a teacher, and that was Franco Baresi. And Baresi, from my childhood, just total legend. Yeah. Total legend.
Thank you for sharing that with us.
Anytime, like, it means something to me and my childhood.
I love experiencing
to Milan
your
fans,
through.
To Milan fans around the world. All right, up next on the programme, the Fed under fire.
The Fed is not the referee in this. The Fed is a player on the field. The rest of the market cannot play the ball without knowing how the Fed might play the ball.
No more football. Up next, the former US Deputy National Security Advisor, Daleep Singh, live from New York City this morning. Good morning. Stocks bouncing back. We're positive by 0.4 on the S&P. We're up by 1.2 on the Nasdaq, heading towards the weekend with another day of gains on the cards, following a really, really big day of gains on the Nasdaq yesterday, the best day of gains in some 5 months or so. If you turn to the bond market, 2s, 10s and 30s, yields have been creeping higher through the week, just a little bit, up this morning again by not even a basis point on 10s, around 470. Under surveillance this morning, the Fed under fire.
The Fed is not the referee in this. The referee sets the rules, enforces the rules, is an impartial arbiter, and the referee doesn't care who wins the game. The Fed cares who wins the game. The Fed has goals and objectives in this. The Fed is a player on the field. The rest of the market cannot play the ball without knowing how the Fed might play the ball.
So here's the latest this morning. Investors doubting Fed Chair Kevin Walsh's credibility and commitment to curb inflation as Wall Street puts pressure on the central bank to clarify its direction. Bloomberg's Tyler Kendall has the latest. Hey, Tyler.
Hey, John, good morning. Well, as our analysts at Bloomberg Economics frame, this felt like a warning shot after a press conference that was, quote, poor on operational guidance. And Washington isn't necessarily helping here either after President Trump quickly praised the Fed chair post-decision, claiming that he knows Kevin Walsh would love to see lower rates. Instead, the administration is accusing others on the FOMC of being politically motivated, even as we hear from those more hawkish members that they're focused on the economic fundamentals amid inflation running above target for the past 5 years. NEC Director Kevin Hassett was on Bloomberg Television yesterday and said that he felt that the PCE numbers from this week should make Walsh's job easier, especially amid that downside surprise to the core reading, adding that maybe the markets need, quote, a couple of more prints like it. But John, the issue is that data is particularly stale given the surge in global energy costs due to the tensions in the Middle East. And I'm sure you saw new this morning, a new statement out from the IRGC maintaining that the Strait of Hormuz remains closed.
Tyler Kendall, with the latest, that tension building with the Saudis as well. You can see that in the price of crude this morning, back into the 90s on Brent just moments ago. That's contributing to that move in yields. Yields higher by about a basis point now. Let's talk to Daleep Singh, the PGIM Vice Chair and former US Deputy National Security Advisor, writing the following. The market is demonstrably running out of patience. The lasting impact of the July meeting is that it will now cost more to regain credibility than it did before. Daleep joins us now for more. Daleep, welcome. You see this a lot. when you do something so poorly, it takes more to make up for it. Are you suggesting that if they do hike in September, it might not be enough?
No, I think if they move in September and they move big, they'll be back on the right path. And look, I mean, I say this with humility and the utmost respect for the Fed because I've been involved in my share of policy mistakes. But when you spotlight a problem like missing the inflation target for 63 months, you declare your resolve to fix it, and then you spend 8.5 weeks offering neither action nor a strategy to do so, it's not a good look. And you invite a credibility shock that makes your job harder. That's what happened.
Daleep, what was it specifically about the news conference that stood out to you as a mistake that needs fixing?
Well, the problem wasn't the decision itself, okay? It was the absence of a strategy to achieve the mission. Instead of a strategy, we heard a suggestion that the market is doing the Fed's work, that higher nominal yields and real yields can partially substitute for rate hikes. We also heard a comment that, who knows, maybe 2% PCE inflation may no longer be the goalpost after January. And that's why we saw long-end bonds, the dollar, and stocks sell off simultaneously, hard, all at once. That was the problem.
Do you think that they're going to be forced to remedy it? And John asked a question about whether they might be forced to do more in September, the idea of a 50 basis point rate hike being put back on the table possibly, or whether you even get some sort of revolt, mutiny by other Fed officials who vote and you see Kevin Walsh in the minority. How do you see this playing out?
I'd say, Lisa, there are two scenarios from here. One is we get immaculate disinflation. Dovish data validate the Fed's patience, and we're going to get two more looks at CPI, two jobs reports, one PCE. I think that's unlikely, but that's a scenario. The second is that inflation remains high and sticky. That's what I expect to be the case. And in that scenario, either the Fed will have to give forward guidance, maybe at Jackson Hole, that hikes are coming, or it lets the bond vigilantes rage in the streets, and it then restores order belatedly by having to go big in September with 50 bips.
Why do you think, Daleep, that it is better to use the front end of the yield curve to tighten inflation, to bring in inflation, than allowing the long end of the yield curve to do the work?
Well, look, I mean, there is something to the argument. Higher long end yields, they do slow investment. They do dent the wealth effect. So I'm not denying that's the case. But they're not a full substitute. For one, higher long end yields, they may not last. So the 30-year yield can spike by 20 bips and then give it all back on a soft inflation print. A Fed rate hike tends to be more durable. The second problem is long end yields, they just tighten a corner of the economy. Housing, yes. Business investment, yes. Maybe consumer durables. But, as Michael Gapin said, the Fed's policy rate is the entire foundation. It's the risk-free price of overnight money. The entire yield curve is bootstrapped from it. The entire financial system is built on top of it. So it reaches every loan, every funding market, every cash flow producing asset in the economy. And that's why rate policy is considered the more blunt instrument. To borrow from Jeremy Stein, it gets into the cracks in a way that higher long end yields driven by the markets do not.
Lisa, I'd add to it. It's a global market. You're outsourcing monetary policy to Japan, to the BOJ, to Germany, to the bond market, to the hyperscalers, anyone that issues at the long end of the curve. You have so much more control over the short term. You can be intentional about it on short rates. Long end rates, do I want the BOJ or the situation with JGBs on any given day to set monetary policy here in America?
Yeah, although you asked a really good question over the past couple of weeks. Is volatility a feature, not a bug? And how much is the volatility in the short term potentially doing the job of the Fed without them having to raise rates?
I don't mind introducing a bit of two-way risk and volatility. I'm not sure that's even what we're talking about, though, is it? It's about building risk premium for the sake of building risk premium. Like, what are we doing that for? Why are we making it all about the long end of the curve? To your point, it's the right question. They haven't explained that. They've been very vague about that. You need to be intentional about why you're doing these things.
So, Daleep, I would ask you, without that kind of guidance, how confident are you to say yield is destiny, and if my destiny is 520, it looks pretty good?
Well, first of all, I think Robert Titt, my colleague at PGIM, trademarked that phrase a few years ago. He's got it tattooed on his shoulder.
That's true.
But go for it with the mugs. Look, I mean, the long end is the whole ball game right now, and we're having more supply from Washington and sovereigns around the world, more supply from Silicon Valley, less demand from a smaller Fed balance sheet, most likely, and now less faith in the Fed's inflation-fighting resolve. So those are now four tailwinds behind a higher term premium, all blowing the same way. So, I think the Fed is going to be forced. It can either take the easy way and hike on its own, and guide that it's going to do so at some point in August, or it'll be forced to do so in September. I think ultimately the Fed will do the right thing. They'll ultimately hike 3 times this year. My view is that argues for gradually adding in the curve flattener risk over the course of this month.
Daleep, just to come back about the economy, because we haven't talked much about it. This is a market issue at the moment. Do you think there are economic consequences to what's developing?
Developing with the Fed or more generally? I mean,
yields
it's all one
climbing higher
conversation.
because of the Fed. Part of the reason also we're getting the hyperscaler debt we're getting. We're seeing yields rise at the long end. We're seeing a market that's tolerating that quite well. Risk assets certainly haven't plunged in response to that. And the economy seems to be tolerating it well, at least for now. Do you think there are economic consequences to it?
Always. I mean, higher long end yields are a tightening of financial conditions. They're going to have real economic effects, particularly in housing, particularly in rate-sensitive investment categories, probably not AI CapEx. And it will have a wealth effect. It will slow consumption that's resulting from valuations that depend on lower rates. But I still think if you step back and ask, how is this economy doing? For me, the backdrop is the same. We have hot demand colliding with supply-side constraints. That's what produces high and sticky inflation. And I don't think the move this week changes that story. I mean, we'll look back and see that empirically, demand was acyclical during the AI build-out phase. Hyperscaler CapEx has proven insensitive to the cost of financing. See what Google said earlier this week. And there's a downstream positive wealth effect from the AI ecosystem to consumption. Plus, on top of that, we have loose fiscal policies. We have hot demand. And I think the problem I had with what we heard earlier this week from the Fed is there's a lack of recognition that the supply side shocks, they're not independent, they're not one-offs, they're not mean reverting, they're recurring and compounding.
Yeah.
In the labor market, in the energy sector, in the trade sector, this is all part of a new geoeconomic regime. And all of these forces are net inflationary. The longer it takes for the Fed to recognize that we've had a structural break, the more difficult it will be to regain credibility.
It's the uncomfortable new normal. Daleep, it's good to see you. Daleep Singh there, and our apologies for the trademark infringement as well. I think we got clearance, right?
I was about to say...
Do we have to give them royalties now?
You know, what do I have to pay you? Trademark.
10 cents
Robert
a month.
Tip. But still, yield is destiny.
Late Shoe of AllianceBernstein. Up next. The opening about 2 hours away. Equity futures adding to yesterday's gains. Futures positive by 1/3% on the S&P. Yesterday, the biggest one-day rally since March of this year on the Nasdaq. The Nasdaq snapping a 6-day slide, the longest since October 2022. Microsoft got it done. Wow, what a one-day gain for one of the biggest companies on the planet. The fastest cloud growth in 4 years.
That was rewarded with a $450 billion increase in the market capitalization, a record. When you think about them adding many big companies and the total market cap of those companies in one day, it gives you a sense of how volatile things have been and how much just one day of getting it done can lead to some pretty massive market cap responses.
Things have been pretty volatile in the bond market too, so let's talk about it. The 2-year yield has been down every single day so far this week, with the exception of today. Yields are higher by a single basis point, 426. The 30-year inching higher by just a handful of basis points on the week, despite a massive move on Wednesday, only up just a little bit on the week.
I love Torsten Slot's note. You were talking about it earlier, saying that it's about inflation. It's about the incredible amount of debt being sold from U.S. and global governments. And it's about the hyperscaler issuance. This is going to be higher for longer. And that's what a lot of people are coming around to. Question is that welcomed or is that a problem for the Federal Reserve? And that question was only widened this week with some of the communication.
Is it by design?
Right.
I think we're all trying to figure that out still. As things stand on the week, yields are higher on the week at the long end of the curve. 5 consecutive weeks of high yields at the long end of the curve. That would be the longest going back to 2023. Let's see. As we count you down to the cash open 2 hours away, let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. Moderna is out with earnings that were better than expected, yet we are seeing shares sinking 8.3% after results for its norovirus vaccine. Early results for that vaccine were not successful. It marks a big setback for Moderna's most important growth programs as the company looks to build beyond its COVID business. But you can see markets punishing companies that, as you said, not getting it done. But One company that did get it done was Amazon, and you are seeing it being rewarded handsomely this morning, up 11%, because it gave investors exactly what they wanted, proof that its massive AI spending is paying off, even after it raised its capex this year from $200 to $220 billion. But that was okay because AWS, the leader in cloud, delivered, growing at its fastest pace in nearly 4 years. And now that Amazon has joined Microsoft and Alphabet in reinforcing that the AI spending is not slowing down, we are seeing a lift across the chip sector with NVIDIA and Broadcom all higher. The rally is also getting a boost after much of the forced selling tied to Leopold Aschenbrenner's AI-focused hedge fund appears to be over. The fund was heavily invested in chip names and the broader AI sector, so its liquidation created technical selling pressure across the sector, but we are seeing that beginning to ease this morning as well, John.
Such a messy year, Yahara, thank you. Just think about it. They effectively blew up being long hardware and short software, and earlier this year we had all these worries about private credit because they were all long, and private markets because they were all long software. So you've had two blow-ups essentially on different sides of the same trade.
Yeah, essentially leverage is a problem if you want to get in on this. The idea that the SaaS coplifts led to, what was it, a hardware get-in?
Concentration is the problem, right?
Maybe that's the fair point.
That's the issue. With leverage on top of that, then you've got a massive problem.
Yeah, and the whipsaw back and forth of what exactly is the correct trade in a time of rapidly changing AI.
Let's get to some of our top stories, shall we? On our radar this morning, Apple disappointing investors after issuing weak guidance tied to surging memory prices and chip shortages. Amazon managing to impress with accelerating cloud sales growth, the company reporting a 37% increase in AWS revenue. Elsewhere, Anthropic announcing its AI models breached 3 unnamed organizations during recent cybersecurity tests. The company discovering the hack after reviewing over 100,000 evaluations. Rival OpenAI making a similar announcement just last week. And finally, Tesla considering a sale of its China business to open the door for a potential merger with SpaceX. The Wall Street Journal reporting some executives have already been told to prepare for the move. Elon Musk, the CEO, denied the report, calling it, quote, fake news.
Either way, and I think you put your finger on this earlier, it is going to be messy for SpaceX to just acquire Tesla without some regulatory safeguards. And this has to do with their huge China presence, which is a significant one for them, one of the largest, second largest market for them, one that has been growing rapidly. They have factories there that produce a lot of parts. That is really the key question. Are they willing to do that? And then how do you get to the valuation that some people have priced in for Tesla as sort of an ancillary unit of SpaceX, which is much larger?
Tesla punished last week for a lot of spending, AI spending remaining intact, with several hyperscalers reaffirming some aggressive capex plans. Amazon, Alphabet, Meta, Microsoft leading the charge, devoting more than $700 billion to spending for this year. Late Chu of AllianceBernstein writing, we have reached an inflection point in AI. Investors should remain selective. Late joins us now for more. Late, good morning. Thanks for being here.
Thank you.
What's changed about this AI trade?
Well, I think, where we are is on the exciting front, we've reached an inflection point in inferencing, in adoption. And that's, I think much of the market focus has been on the CapEx side. But let's take a step back and then see what we've seen through this earnings period. What we've also seen is revenue upside, backlog, massive amount of backlog these hyperscalers are delivering. And, a lot of people have been calling the AI being a bubble. In my experience, it's very hard to call something being over when we just reached the rapid adoption phase. So if you ask me what has changed, we've been on the journey and we just reached an inflection point.
Well, let's talk about the companies that are being punished and the ones that are being rewarded. So Alphabet was punished, Microsoft was rewarded. What was the distinction between the two for you?
I suppose it's less so about they're that different as in the timing of it. And this month and this week, we've seen massive volatility in the marketplace. And I think that's one of the issues that we have had. And some of it's technical, some of it is led to, is sort of what you talked about, the leverage in the system at the investor level. And these, in my opinion, when you look at the results, they're fairly similar to some extent. We're seeing revenue acceleration, we're seeing CapEx remain firm, and we're seeing these companies actually really innovatively trying to figure out ways to lower their cost base as well. So I think in general, results were similar. It was just more which day of the week did they report and where were we sitting in the middle of a massive sell-off.
So to John's point earlier when he's talking about how it was the SaaS uplifts early in the year and then suddenly it was the hardware names, the chip names selling off, how much do you see that narrative kind of continuing to oscillate between the two as people keep investing in the hardware and the infrastructure? That seems to be a feature of this entire cycle that has to keep going.
At this point, I mean, we've seen it even from Apple's results, which has been phenomenal in terms of supply chain management. When they're talking about component shortages and when they're talking about pricing increase at the chips level, at the memory level, you see that, we are having shortages. We are still, I would say, overall in the earlier phase of the build out, and especially when you see revenue accelerating, these hyperscalers. And if you're a business owner, if you see business coming in, you should be building. So I think we will still continue to see really strong spend throughout. But in the meantime, most important thing for us to take away this earnings period is that we see adoption, we see revenue accelerating. That to me is the most important sign. And as long as we see that, I think the ecosystem remains healthy.
As an investor, how important is it for you to hear from the C-suite clarity of vision?
It's particularly important when we are in once-in-a-lifetime massive changes at the infrastructure level. So it's important to understand what they're spending on, how they see the future. And it's more important than ever for us to scrutinize and then to ensure that our vision, our belief is aligned with the companies that we invest in. And furthermore, I would say the one thing that we are talking about is as a whole, CapEx is very strong. But underneath it, even when you look at it, stock selection is extremely important. It's not rising tide lift all boat. And I think more than ever, because the pace of innovation is so fast, and then because this time it's some of the biggest spenders actively looking at what they're spending on, and they're scrutinizing that spend. So we are likely going to see, even at the spending level, even at the supply chain, you're going to see continued pace of innovation going faster. And as a result, the market is also going to pricing in, like when we think about SaaS or some of the company that we think might be disrupted in the marketplace, the market quickly is pricing in the probability of success at the terminal level. And I think we're going to look at that at the hardware level as well. The architectural change is actually happening at a much faster cadence than we ever imagined, and partly aided by technology. And so I think as an investor, it's very important for investors to remain very prudent and selective and pick the right winners, even though in the overall narrative has constantly been focusing on how big that number is.
This has not been a forgiving market, that's for sure. Leah, appreciate your time this morning. Thanks for being here. Leah Chu there of AllianceBernstein. The Nasdaq up this morning by 1% with an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Saudi Arabia holding talks with 43 countries on forming a multinational alliance to protect shipping in the Red Sea. The Saudis proposed leading the coalition. The plan receiving support from 13 countries, including Turkey, Egypt and Qatar. Ken Griffin's Citadel stepping in to rescue a hedge fund. Situational awareness selling off a heavy chunk of its portfolio. Citadel buying up the bulk of the fund's AI stock bets. Shares of Novo Nordisk are falling in the pre-market. The company giving an update on its Zeus Phase 3 trial, saying it failed to reduce the risk of heart attacks or strokes in a large study. The monthly injection was a key part of Novo's effort to expand beyond its core obesity and diabetes businesses. And that's your Bloomberg brief. John.
Hey, Vonnie, thank you. Appreciate it. Up next on the programme, dry powder on the sidelines.
There's $4.5 trillion of dry powder across the private markets, which is just an astonishing figure. I almost think about it as a waterfall of capital markets depth.
Up next, we'll catch up with the Ares CEO, Mike Arougheti, from New York City this morning. Good morning. You're watching Bloomberg TV. Equity futures positive here by a third of 1% on the S&P, adding to yesterday's gain, the biggest one-day gain on the Nasdaq we've seen since March, following a 6-day slide, the longest losing streak, going back to October 22 for the Nasdaq. The Nasdaq this morning up by 1%. Into the bond market, 2s, 10s and 30s. Lots of reasons for higher 30-year bond yields on the week this morning. just sticking at about 520. Lots of people talking about Kevin Walsh and that performance on Wednesday, but there's so much more going into high yields at the long end of the curve.
It has to do with government issuance, and it has to do with hyperscaler issuance, and it has to do with the fact that central banks around the world don't seem to be in a rush to raise rates to counter inflation. And so they're allowing the long end of the yield curve to do the work for them.
30-year yields this morning, just about unchanged at 522. And the surveillance this morning, dry powder on the sidelines.
There's $4.5 trillion of dry powder across the private markets, which is just an astonishing figure. There's broad demand, and you're already seeing it in the 2026 patterns where some of these companies are actually choosing to issue in the private markets. I almost think about it as a waterfall of capital markets depth.
So here's the latest this morning. Ares reporting an earnings beat, highlighting another record quarter of fundraising with over $36 billion of inflows. The CEO, Mike Arougheti, writing, "Our clients continue to reward us due to our strong and consistent fund performance across our strategies." Mike joins us now in the studio for more. Mike, good morning. Good to see you.
Good morning. Good morning.
I wanted to start with a quote of yours from earlier this year when things were pretty difficult with the software issue. And you said something really important. You said the following: if you're going to underwrite a narrative of AI disruption, you also then have to say, well, what does that mean for the productivity and margin improvement for the rest of your book? I think that's a good place to start. Where are you seeing value being created right now?
I'm glad I said that. So if you look at the way that Ares is playing the AI transformation, it's what are we doing within the data center and digital infrastructure space? What are we doing within our portfolio companies, and what's that productivity uplift? And then what are we doing within Ares proper to either improve our investment outcomes or profitability? So if you start with Ares first, we're obviously deploying AI across the entire enterprise. We're seeing significant efficiency. We had a 100 basis point margin increase in the quarter year over year, and we've guided the street to expect 0 to 150 basis points per annum. A fair amount of that is technology efficiency that's getting created, re-underwriting processes, re-underwriting systems, and we are seeing uplift. That is also translating into increased productivity and margin expansion within the portfolios. So if you were to look across our private equity portfolios, our private credit portfolios, cash flow growth is still plus or minus 10%. If you look at corporate earnings, I think you're going to see that that's generally the theme. And then within the investment space, we are doing our best to stay diversified in the way that we're attacking the digital infrastructure opportunity. Big investors in data center development, but I think our approach has tended to be a little bit more targeted. We're doing 150 to 300 megawatt deals, hyperscaler adjacent in large tier one markets like Tokyo, London, Sao Paulo, pre-leased 12 to 15-year terms with escalators. So we have probably shied away from some of the secondary and tertiary markets and stayed away from some of the frontier model type of opportunities. Two, we're a very large lender in the infrastructure debt space, and you're seeing that rolling through our earnings as well in terms of the fundraising and deployment momentum there. So we are one of the largest institutional lenders to other developers, and that's been a bright spot. Three, we have a large asset-based finance business, and we're squaring off with a lot of the banks on SRTs and portfolio purchases, where we're helping them free up liquidity on their balance sheet to continue to deploy into the opportunity. And then four, we have a very large infrastructure equity business where we're investing all around the digital ecosystem, transmission, fiber, battery storage, et cetera. So we're kind of attacking it from all angles, but our view has been we want to be global, we want to be diversified, and we want to have the full capital structure so that we can move around where we see best relative value.
It's the second word I want to dig into, diversified. Yeah. And I'm open to the reality check. I'm just going to say it feels. It feels like a lot of people are in the same trades. They're in asset-backed infrastructure debt on the credit side, and they're taking direct equity investments into, say, software and models. How do you avoid all the crowding that we're starting to see in other places?
In digital specifically?
Within your firm?
Yeah, I think the key, and this goes, if you look at our earnings this quarter, and you put the numbers up on the screen, what screams out to me is just the broad-based nature of the business and the diversification. And so the way that we think about private markets is we want to be up and down the capital structure, debt to equity, so that we can move around and find relative value in response to rates or the economic environment. We want to be horizontally diversified across all the different private market asset classes, secondaries, private equity, real estate, infra, and you'll see investor appetite and our own view of relative value shift. And then within the funds, we want to be highly, highly diversified. So if you look at our credit funds as an example, you may see 900 to 1,000 line items. So we're not going to have any single exposure really drive the long-term performance. And I think that's key. There is a risk in any investment business that you're over-diversified. And I could argue maybe 1,000 loans in one fund is over-diversified, but it's served us well over the 30 years that we've been doing it.
Earlier this year, everyone was saying there's going to be a complete collapse, that the private credit space is going to go down in flames because of the retail investors, et cetera. And your compatriots and yourself are coming out and saying, whoa, not at all. We're seeing actually performance hang in there and people are still interested. Where are we in that in terms of interest from investors in private credit, how much the pendulum has shifted to the infrastructure and some of the other plays instead?
Yeah, look, we've been pioneers in private credit, and people have been saying it's a bad place to be for 30 years, and it's grown pretty consistently and compounded at a very attractive rate of return. So anytime there's a narrative that's that loud, you've got to at least ask yourself, what is it that they're looking at? We don't see it. If you look at our direct lending business, which is kind of where I think people are focused, our non-accruals across the direct lending business right now are inside of 2%. That is well below the historical averages. Our cash flow growth is plus or minus 10%, as I said, and that's been consistent. We are seeing healthy interest coverage, very low loans to value. So the fundamental performance is exactly what was underwritten. A lot of the noise, I don't really know where it's coming from. It could be coming from a competitive set of capital that, doesn't like to see the flows. It could be software related, but there's nothing that we see in the portfolios that would indicate that credit's weakening. And the interesting thing to your question, and you see it this quarter in earnings, the institutional demand for private credit is probably accelerating right now because they're seeing spreads widening and they're seeing capital leave the market and feel like there's an opportunity to come in and take share. So our last two credit funds, both in asset-based finance and opportunistic credit, hit their hard caps, and we had demand well in excess of the hard caps, and we raised those funds quicker than any prior vintage.
It's fascinating to hear you talk about the performance of these loans, and it's something that we've seen from the likes of Capital One and some of these other credit card companies. The credit performance is hanging in there. Yeah. It's actually hanging in there better than people expected. Where are we in this economic cycle based on some of the activity that you're seeing in portfolio companies?
Yeah, if anything, you could say growth is moderating slightly. So if we're growing cash flow portfolio-wide 9 to 10%, a year ago that may have been 11 or 12. But it's not negative. So you are slow growth. I mean, where are we? It's still early. And back to the first question from Jonathan, you're seeing margin improvement, productivity gains, balance sheets are healthy, companies are delevered. So it feels pretty good, and it's just not in corporate. We see it in the real estate market too. We're well leased. We're seeing rent increases and strong demand. So everything feels really good.
Right now, we're talking about leverage coming out of the system in public markets. There was some concern that maybe leverage was building, or there was some frothy types of behavior in private asset management. You talk about $170 billion of dry powder. I'm just wondering how you see some of these structural dynamics in the market in terms of ability to finance some of the huge bills coming and willingness to do so.
Yeah, look, I think $170 billion of dry powder feels like a lot, but it's actually kind of in line with our annual deployment. So if you look at the $36 billion that we raised this quarter, we also deployed $36 billion. That's actually a lot quicker than historical. It used to take us probably 2 to 3 years to deploy our dry powder. We're now almost on an annual raise and deploy. I think with regard to the digital CapEx, obviously there's $750+ billion of CapEx demand coming from the hyperscalers. That is a large amount of capital. It's beginning to, quote unquote, overwhelm the markets, and that's showing up in two ways. One, spreads are widening, which is not necessarily a bad thing, and people want to get paid more for the risk that they're taking. And it's probably slowing the pace of the build. So, when you're thinking about deployment, this is not happening overnight. These are 2 to 4 year projects. You've got energy constraints. You've got community engagement and civic discussions that have to go well. So there's a lot that's actually constraining the coming online of some of this CapEx. So at least as we're sitting here today, those numbers don't concern me. But your point is a good one. And going back to a year ago, people were beginning to ask, where's all this capital going to come from? The CapEx numbers have doubled, and the market is trying to keep pace, but it's going to be a little bit of a constraint, I think.
I thought you were about to ask whether Leopold had given Mike a call. When you talked about the dry powder, I thought maybe.
Maybe. I mean, maybe you were the one that was the Grim Reaper calling. Did you hear some? I love those quotes. Did he give you a call?
No.
Breaking news. And with Ken Griffin, just kidding.
Are there any lessons from that? As you see that story and react to it in real time?
I don't know enough to know. I think, if anything, maybe back to your prior question, is be diversified, number one, which is, don't be fully exposed to one factor or single correlation. I think that's, that might be the lesson. It might be that experience matters, and that, combination of smarts and experience through cycles is ultimately important. And I think, I think about our own 30-year journey and all the lessons that we've learned navigating cycles and
painful ones,
things, and you'll learn lessons the hard way. And so that might be the moral of the story too.
Mike, appreciate it.
Thank
Good to see you.
Good
Thank
to
you,
see
buddy.
you
Thanks for being here.
Thanks.
Thank you very much. Mike Arougheti there, the Ares CEO. So that's a no. Leopold didn't give him a call.
Well, it's a different asset class, I guess. But it does highlight the role of experience in this. I mean, 24, idiot savant, or not idiot, but, that sort of an incredible, brilliant guy.
Strong, Bremo.
Well, no, but it's like it's a phrase. He's graduated college at 19. No, that wasn't. No.
Running out of time here to clean this up.
Look at that. The time's got to go. Yield is destiny.
15 seconds to dig out of this hole if you want.
No, he's a brilliant guy. 24.
Okay. From New York City this morning, good morning. The third hour of Bloomberg Surveillance up next.
There's still lots of demand for equities.
Right now, we're in the middle of a good growth cycle.
What we really need to see is continued strong earnings growth.
Once again, we have these broad-based earnings surprises.
Earnings are opinion, cash flow is fact.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Yield is destiny. Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now with equity futures positive by a third, adding some weight to the rally of the last 24 hours on the NASDAQ. The NASDAQ delivering the biggest one-day gain since March, adding another 1% to the NASDAQ 100 this morning. In the bond market, 2s, 10s and 30s, yields shaping up as follows. Yields this morning on 2s up by 2 basis points to 426, on 10s around 468.
Yeah, and the real key question here is, what is the relationship with the global trade and what is the relationship with the Federal Reserve? We heard from Kevin Walsh, the Fed chair, a speech that was widely panned on Wall Street, but gave a lack of clarity about what the actual calculus would be when they were deciding whether or not to raise rates. Now we're hearing from some of the other officials about why they dissented, and some of those might suck up a lot of the oxygen.
Mike McKee is going through those dissents. I understand that Mike McKee is available to talk to right now about it. Mike, clarity. We didn't get much from Kevin Walsh. How much clarity are we getting from some of those dissenters this morning?
We're getting a lot more. It's become something of a thing that on the Friday after a Wednesday Fed meeting, the dissenters published statements explaining their votes, and we've got statements from two of them, Beth Hammack and Neil Kashkari. Hammack cites supply shocks, but also says that she sees inflationary pressures on the demand side of the economy as well. Businesses in her district, she says, are telling her that pricing pressures are broadening rather than fading, and she notes consumers are expressing despair over persistently higher prices. Inflation has been too high for too long. In my view, now is the time for the FOMC to act to speed the return of PCE inflation to our 2% objective and deliver on our commitment to price stability for the American people. And she notes that the longer inflation persists, the more challenging and costly it is to bring it back down. She also says that she's not confident it will return to their objective on its own. Kashkari worries about the effects of the series of supply shocks the economy has faced, as well as new demand from AI. He looks to the oil shocks of the 1970s and the ultimate decision of the Volcker Fed to lean against those shocks rather than accommodate them. To manage against the risk that high inflation would become entrenched, Khajuria says, I would rather tighten policy incrementally as we gather more data on the path of inflation and unemployment. If inflation remains elevated, in my view, a potential series of small policy moves would be better than waiting and eventually concluding that even bolder actions were necessary. And of course, on the other hand, if inflation fades, he says moving in slow, small steps would allow the Fed to dial back the stimulus without unnecessary impact on the real economy. We have not heard from Lori Logan, the third dissenter, but we are, since it's a thing now, expecting to get something from her later today.
Looking forward to your coverage of it. Mike McKee there breaking down the dissents of Hammack of Cleveland and Khajuria of Minneapolis. Let's start with Khajuria of Minneapolis. I give him credit for being consistent and slightly early, pushing back against the easing bias in the statement a number of months ago, suggesting that the earlier you move, the less you'll have to do further down the line, and that we could see some tightening of financial conditions. And then now, ultimately making the point again that the earlier we move, the more incremental we can be, and the less we might have to do later. But of course, this is dragging on and on. It's the word incremental hikes, those two words that get my attention from Khajuria this morning.
Yeah, saying that a series of small incremental hikes is preferable to acting when you finally allowed inflation to get away from itself, and actually arguing that, yes, monetary policy can have a role in dampening supply-side, supply shock-driven inflation, kind of rebutting the argument that this isn't their battle to fight. Ultimately, if inflation is a choice and it is their choice, he's saying they should do something about it. Here's the question. If Lori Logan comes out with this type of statement, it puts all of the non-speaking Fed members on the hot seat. Where do you stand, given that we haven't heard the rhetoric, the argument for remaining on hold this week at the Fed's meeting?
If you're on the board of governors, let's just park the regional Fed presidents just for a moment. If you're on the board of governors right now, I imagine you feel quite sensitive to the idea that a new guy's just taken the role, and you want to give them some time, which might be, and I stress might be, because I don't know and have no inside line on this whatsoever, it might be why Waller did not dissent at this meeting. I would look for clarity on that. It's the governors I'm looking for, because right now, based on this commentary, the Fed chair's running out of time. And you're going to have to see the data do a lot of heavy lifting between now and the September meeting to stop this pressure from building even more.
Just like Daleep Singh said, if you do get a sort of immaculate disinflation, that could take the pressure off in a significant way. But without that, a lot of these voices are going to get a whole lot louder.
Let's get to the view on Wall Street this morning. Phil Camporeale of JP Morgan Wealth Management writing the move in the yield curve after the press conference is something that every Fed chair would want to avoid. They would much rather be transparent heading into the meeting versus the driver of material price action. Phil joins us now for more. Phil, good morning.
Good morning.
Whole new world. How many times have we said that this week?
Yeah.
What's your reaction to Wednesday and your reaction to this morning?
Yeah, bond market freak out. We haven't gotten that in a long time. And it does remind me, there was this Chair Powell press conference from October of 2018. I'm not sure if you guys remember when he said, you know, President Trump was very, very critical of him. And
long way from neutral, that line.
Yeah, good one, John.
I don't remember if it was the presser or if it was an interview or testimony.
We're far away from our neutral rate.
But that was the line.
And the bond market was like, what? How many more tightenings does that imply? It ended up being one more tightening in December, a pause in January, and then they were easing by July. Like, this stuff moves very, very quickly. But more importantly, John, as I wrote, no Fed chair wants to see a reaction like that in the bond market after they talk, because they want to be transparent. I remember when Janet Yellen compared monetary policy to like watching paint dry, right? That's what they want monetary policy to look like. And that could be course corrected. I think that's the bottom line here. When the statement came out, there were 3 dissents. Fine. 3/4 of the committee didn't see enough evidence that the impact of what energy prices would be doing to broader inflation. And the statement was fine. It was the press conference. And I think they can, or Chair Walsh can course correct that. At the end of the day, though, I still go back to the 10-year Treasury rate and the volatility of rates. I think the federal funds rate is priced to move 1 or 1.5 times by the end of the year. And it's kind of interesting, because when we have our strategy meetings, you have the bond people on one side, and they're like, oh my goodness, look what's happening. And then you have the equity people, and they're like 20% equity earnings growth, right? And this is a trade that we still like. And that's really the disconnect here. It's yes, there's a lot of consternation in the bond market this week, but the equity trade continues, we think, to have momentum and legs. And we're going to look back on July, And this month, we're going to have an unchanged month in the S&P 500.
Yep.
But it felt more like the Odyssey than an unchanged month in the S&P 500.
A few points away from all-time highs as well.
Yeah.
You serve wealth management clients.
Yeah.
If they're in the clip and coupon business and they're not too worried about the volatility, the income that fixed income provides now is higher.
Yeah, that's the key.
Is this a buy after the freak out?
Yeah, that's the key. So we are of the view, John, that the 10-year Treasury probably stays at or around these levels through the end of the year, which leads us to believe that, yes, you have the power of carry on your side. If the Federal Reserve is already priced to go 1 to 2 times this year, then you're not really talking about a dramatic move. It's kind of like buy the room, sell the fact, dramatic move in the long end, unless we're really wrong about these next 2 CPI numbers and these next 2 payroll numbers that show significant strength that, Lisa, I think you mentioned earlier this morning, could maybe prompt the Fed to do more. So yes, we do believe that it's a buying opportunity in fixed income to take advantage of these current yields. But, John, we are looking in the front end of the curve because I think there's a little bit more of an opportunity there than in the back end of the curve that could have more duration and volatility just in the near term.
I remember late last year, a lot of people were talking about how the pendulum of risk-reward had really shifted more to equities than potentially from bonds, just based on where spreads were, based on the potential earnings ahead for particularly tech companies. Do you think that pendulum is shifting back, that higher yields means lower returns from equities for a longer period of time?
No, because I do believe it's still the equity side, Lisa, that we're leaning into, because we think that this earnings story is interest rate insensitive. And that sounds kind of blasphemous to say. But again, we have a 24% earnings forecast for 2026. And the only other times that we were 20% in a calendar year were coming out of the 2001 recession, the global financial crisis, and the pandemic. And we're doing this in the middle of a cycle. And I think this month especially, the fundamentals have completely dislocated, right, from the price action of some of the hardest hit sectors, which were, tech, communication services, industrials. And, if you look at the earnings revisions, they're positive. That's usually what drives stocks, but the price action was lower. And I think we're still leaning into that tech trade more than bonds. But bonds, again, at these levels, you really need a Federal Reserve that's going to be super hawkish to get hurt. And legging into a 10-year note at 470, if your high side looks something maybe like 5%, doesn't sound like a bad idea when you're getting paid for that carry.
Where in equities is the best place to go? Because we've heard from Mike Wilson about the broadening trade, and we just heard from Mike Arougheti of Ares about the incredible efficiency gains and increased profitability that non-tech related companies are experiencing. Is that where ultimately the upside is going to come from?
Yeah, so our favorite sectors are tech still, industrials that are tied to the tech trade, but introducing financials. Financials are also a sector that we like. And I think what's happening, when you see the Mag 7 versus the 493, when you see that valuation at points that we haven't seen in a decade, I actually think it has more to do with the 493 than the 7. And investors buying into and having confidence in that those sectors are going to be more profitable, that there can be non-tech sectors that are profitable, like financials. And financials are one of the biggest deltas or changes in our earnings revisions. Buybacks are really important in financials. And capital market activity. I mean, I'm sure you guys covered the JP Morgan results, the Goldman results, and the way that those CEOs talked about capital market activity. And Lisa, again, that's the disconnect, right? You have the fixed income people freaking out this week. Oh my goodness, we may need to see yield is destiny. You may need to see a rate hike.
You're not letting that go, are you? Hey?
Never.
That's going nowhere.
But this remains a pro-cyclical trade. And again, earnings are driven not just by growth, but by nominal growth. So inflation is bad without growth, but if we have a 2% GDP growth forecast and 3% inflation forecast, 5% nominal growth is a good environment to take risk in.
We found something to blame. Can we finish on situational awareness?
Yes.
The hedge fund's blown up, someone stepped in and picked up the positioning. Do you think that's a sign of a washout, a clearing of positions where we can form a new base and pick up from here?
Yeah, we do. And one of the things that we like to look at are retail flows and ETF flows. And John, the move in the tech ETF and the semi-equipment ETF, those outflows last week were some of the biggest on record. right? So akin to what you were just talking about outflows, that's what I think kind of makes a floor where you can then get back to the fundamental story. Oh my goodness, these folks are adding to their capital expenditures. There still is a supply-demand imbalance on semiconductor demand versus supply, which I think keeps this thing moving forward.
Good to see you, buddy. As always, Phil Camporeale there, JP Morgan. Private wealth management rather. I just want to get to this statement from HSBC and Max Kettner, because he talks about that in this new note this morning, Bramo. He says, yesterday's news around the unwind of AI hedge fund situational awareness gives markets a welcome narrative to justify the renewed sell-off in chip stocks in the past 2 weeks. Goes on to say that technicals have also become much cleaner now. In our view, this creates a powerful backdrop for a positive reversal of Momo, says we shift EM Asia equities back to overweight, reduce Eurozone equities, remain overweight US and Japanese equities.
Yeah, this max overweight in equities continuing. Interestingly, remain quite aggressively underweight developed market sovereigns to fund or carry an equity overweight position. So this is coming at the expense of yield in terms of yield is destiny, yield is going higher, and the developed world is going to continue to struggle with that. That's not undermining, though, the overweight in some of these momentum sectors.
Interesting note from Max this morning.
Very.
Just interesting. And Phil was talking about the same thing. Maybe just, you know, whether it's the right thing to blame, but something for the people who are in denial to blame, maybe, about the last few weeks.
I think we have more situational awareness about
Yes, maybe we do. Or maybe we don't. Let's get you an update on news elsewhere this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. 2 of the 3 Fed presidents who dissented at Wednesday's meeting are speaking out now. Cleveland's Beth Hammock saying now is the time to speed the return of PCE inflation to 2%. Minneapolis's Neel Kashkari saying he'd rather tighten policy incrementally as the Fed gathers data on inflation and unemployment. Anthropic says its AI models breached 3 organizations during recent cybersecurity tests. In a blog post, Anthropic says it found 3 instances in which its Claude AI tool accessed the internet and then hacked into external organizations. Shares of Jersey Mike's slumping nearly 9% in their trading debut. The company and some of its shareholders raised $1 billion in an IPO that priced at the midpoint of its marketed range. And that is your Bloomberg Brief. John.
Vonnie, thank you. More from Vonnie in 30 minutes. Up next, the morning calls, plus Shweta Khajuria of Wolfe Research's Amazon soars, capping off hyperscaler earnings on a high note. That conversation up next from New York City this morning. Good morning.
What we're seeing here is the hyperscalers leading a massive round of CapEx, which is contributing to supply shortages and inflation in component costs. This will resolve itself over time. This is a short-term issue, but in this case, short-term could be 12 to 18 months. But it'll eventually take care of itself.
That was Tom Forte of Maxim Group weighing in on Apple. Apple struggling in the pre-market. More on that name throughout this morning into the opening bell. The cash open 1 hour and 12 minutes away. Let's talk about the stock market. Equity futures positive by 0.25%. The Nasdaq doing better, higher by 0.8%. There's a fantastic story out there about a hedge fund called Situational Awareness. All the characters involved. It's a great one. You could write a book on it, I'm sure. When Ken Griffin of Citadel's doing the rounds too, there's always extra meat to it. But the essence of it is you had a guy who was running a strategy that was very long hardware, very short software, and was using lots and lots of leverage. That produced fantastic returns for much of the year until it didn't. And things unwound really, really fast. Did that contribute to the weakness that we started to see in, say, chips? Did the unwinding of those trades contribute to some of the big moves we started to see over the past few weeks? Maybe to some extent, possibly, yeah. Do you believe that now sets a base, a cleaner base to rally from here because we've washed out some of this positioning? I think some people believe that this morning. And this came from Max Kettner of HSBC, and it's an important line. That yesterday's news around the unwind of the hedge fund situational awareness gives markets a welcome narrative to justify the renewed sell-off in chip stocks in the past few weeks. Technicals have become much cleaner now. In our view, this creates a powerful backdrop for a positive reversal.
And this goes to a point that a lot of people have been talking about, which is the technical nature of the market over the past couple of weeks, rather than anything having to do with fundamentals. We talked about Samsung, SK Hynix, Samsung more so, coming out with really good earnings and still getting beaten up for it. It's also coming in tandem with the South Korean market stabilizing a bit, with authorities putting some sort of caps on the use of leveraged ETFs.
I'll tell you what, Bramo, I can't keep up with the news flow. No. I was looking at this headline just crossed on the Bloomberg. I mean, let's bring it up right now. Moonshot's Kimi was built on 20,000 NVIDIA chip cluster through Alibaba.
Oh, dear Lord.
You know?
Yeah, well, this is the whole question of how much of the Chinese technology is being built on smuggled equipment from the United States, or things that have been sanctioned in some capacity. There will be a lot of questions.
How export compliant is it all? There could be questions about that. Where's the technology coming from? Is it just US tech dressed up as something else? How much of a threat is this to US markets? Is it another shock like DeepSeek just last year? These are all questions we're trying to answer in real time.
And just how much cheaper is it actually than some of the frontier models? I mean, the big argument is that it's cheaper, it's open source, but it turns out when you dig under the hood, it's using a lot of the same compute, a lot of the same technology, and it costs a very close kind of amount.
This is according to our reporting, but what it underlines still is that on the surface, yes, we're seeing some progress from China, but there's an underlying dependence on US technology. So if you thought that story a few weeks ago was a reason to sell US tech, I think you're rethinking that based on the reports we've seen over the last few weeks.
Yeah, which maybe is also giving some stabilization. It isn't exactly a one-for-one type of disruptor that people had imagined.
I'm running out of time here, so I've got to move on. So let's get to the morning calls. One stock in focus, Amazon. Barclays raising its price target, saying it's, quote, atop the AI hyperscaler pedestal. His second call from JP Morgan hiking its price target, noting a clear line of sight to strong financial returns. And finally, Citi lifting its price target too, citing booming AI demand and calling it a top pick. The tech trade then regaining its footing after a blockbuster week of earnings. Amazon surging on growing cloud strength. Apple facing some headwinds. Ed Ludlow has the news wrap. Hey, Ed.
Yeah, good morning, John. The markets with Apple had no sentimentality for Tim Cook's final call. It came down to a really critical question, which is what does the world look like in 3 months relative to today? And Apple made some pretty stunning concessions that they had misjudged demand on the smartphone side and on other products. And so it wasn't even a case of memory. Yes, memory prices will go up, but even in lead-edge processors, Apple basically didn't ask suppliers enough. They made a misjudgment. And so the September quarter and the outlook of growth of 9 to 11%, trailing the street's expectations, it is pretty amazing to see the stock down almost 8% in the pre-market as a result. Amazon, a completely different story, right? They told the market, our AI investments are already paying off, and quite clearly the market believes them. Capital expenditures rising from $200 billion to $220 billion. Azure growth, 37% growth in the quarter gone, above expectations. But loads of other data points that show they're making money on AI, and the street believes that.
The stock's behind the story. Ed, thank you. The stock is higher by 10% this morning. Shweta Khajuria of Wolfe Research staying bullish on Amazon, writing the second quarter was a clean beat and third quarter guidance came in line with investor expectations. We see a path to 40% full-year growth. Shweta joins us now for more. Shweta, welcome to the programme. What was the difference between them and, say, the likes of Meta, the likes of Alphabet?
Good morning. Thanks for having me again. Well, Amazon, as far as I remember in the recent past, had one of the cleanest prints. And what was different between Amazon and Meta and Google was that Andy Jassy actually talked about the clear line of sight into return on invested capital, how they're seeing demand, how they're laying out data centers in the first 2 years, and then they break even post, a couple years after they put in servers and networking investments. And the life cycle and the length of the life of each is different. And they think that this is just a very similar playbook as how they expanded AWS with just much faster growth that they're seeing in AI. And so that gave investors a lot of comfort that they're spending against a lot of demand. They have concrete demand. They are not going to spend if they don't see it. And there is line of sight to seeing returns. And most importantly, they're doing this from a position of strength. And they've done something like this before. So that is probably the biggest difference between across the three.
Shweta, is Amazon essentially a cloud computing company with a retail arm tacked on?
It's really amazing how things have turned around. I mean, still retail is their biggest revenue business, not operating income or profit business. But what is remarkable is that if you really believe in the $1 trillion revenue opportunity at AWS, and let's say that it reaches that in 10 years, at low to mid 30% margins, assuming that's the normalized state of their margin profile, it is amazing that that would be about 2/3 to 70% of their total company level operating income. So vast majority of their enterprise value would be coming from AWS. So yes, I would think so in characterizing it as more of a cloud computing AI company than retail.
Isn't it funny, Lisa, if you ask someone on the street away from Wall Street what they know Amazon for, obviously it's retail. They wouldn't even be talking about the other part of the business. In fact, I would guess that most people on the planet away from Wall Street, when they think of this company, don't even know the other side of the company exists.
Dinner the other night, one of the kids was like, how did they get it so much cheaper than everybody else? And I said, cloud computing. Pew, mind blown.
Totally.
That's exactly how it gives them a competitive advantage to potentially compete on price in a whole different kind of way.
Almost by accident, they end up with that business.
I know.
It's nuts.
I know. It came from, selling books online, and suddenly now they, are the reason why we
You need quite an imagination to think you'd get from that to this.
And the imagination is what people are buying into.
Shweta, appreciate it. It's good to see you. Shweta Khajuria there of Wolfe Research. The stock is higher by almost 11% at the pre-market. Up next, we'll catch up with the former New York Fed President Bill Dudley, seeing some major red flags in Fed Chair Kevin Walsh's strategy. That conversation is up next. Equity futures this morning positive by 0.25% as a bounce on the Nasdaq, up by 0.9. That bounce continues following yesterday's big gain. In the bond market, 2s, 10s and 30s, some data just seconds away. Yields at the front end of the curve up 3 basis points, around 430 on 2s. Let's call this 427. Yields up a single basis point on 10s, behaving just a little bit on 30s at 521, following the freak out on Wednesday and the news conference with that Federal Reserve. We'll spend some time on that in a moment with the former New York Fed President Bill Dudley. Looking forward to that. Let's get you some economic data. Mike McKee has that data for you. Hey, Mike.
Good morning, John. Well, we've got another inflation indicator. The employment cost index for the second quarter is just out, and it is up 0.9%. That's higher than the 0.8 the prior month, or the 0.8 it was expected prior quarter. Excuse me. We see that wages and salaries were up 0.9%, and business benefit costs increased 1%. So a little bit more inflation on the employment side in terms of compensation. Not sure whether that will influence the Fed a whole lot, since we've got a lot more inflation between now and September 18th, their next meeting. But it does show you that inflation is not dead, and it sort of helps undergird the cases that Beth Hammack and Neil Kashkari were making this morning for their dissents.
Mike McKee, thank you. I just want to pick up on the bond market move and just go to the front end of the yield curve. And I won't make too much of a big deal of this. I'll just talk about it directionally. So we're higher by 3 basis points. And if you look across the curve and just look at 2s, 10s, 30s all at the same time, just look at this. How the markets responded to the data. I think this is actually quite important. And I'll tell you why. So 2-year yields have responded by climbing 3 basis points. The 30 has not moved. So that's a market that still believes on the margin that that kind of data would influence the policy rate of the Fed. And it's not something they would look through. Now, it's just one data point. But if things had really changed after Wednesday, you'd expect to see that leakage at the longer end of the curve in the belief that you don't actually think the Fed's going to do anything and they're just going to let inflation run. So I think still out there, internalized within this market, investors still believe that this Fed is sensitive to incoming information and yields are higher at the front end.
The Fed is composed of individuals, and the individuals have different views, as we're learning this morning, and they're all coming out with some dissents. And what people are looking for, you're going to expect to see more volatility around every single data dump that we get, because ultimately, if you get data that does not cooperate with this immaculate disinflation narrative, there will be a lot more people on this FOMC committee that are going to come out and vote with Logan, Hammack, and Kashkari, and might even put the Fed chair, Kevin Walsh, in the minority.
It's a small move, Brammer, but you're with me? That's kind of how to think about this right now?
Essentially, the market is saying that at a certain point, if the data confirms that inflation is sticky and it really is continuing to move in the wrong direction, that the members of the Fed, regardless of what Kevin Walsh does, are going to be forced to make a move. And the market is forcing that hand and saying they probably will follow through on it.
Yields up 3 basis points this morning on 2s. It's a small move, but the direction, the response, the sensitivity to the data as it comes in is noteworthy. Mike, you've been following those dissents. What have we learned so far this morning?
Oh, basically that both Hammock and Kashkari believe that if you start raising rates in small increments now, you'll have to do less later, because they do think that inflation is going to continue to be above target significantly for quite some time, and that that inflation rate is not going to come down towards the target on its own. It needs more help. It needs more tightening in the economy. We haven't heard from Logan yet, but she has made that same case before, so I would assume that she's dissented sort of on the same basis.
Stay tuned. Mike, thank you. Michael McKee there. The former New York Fed President, Bill Dudley, with a new op-ed titled "Walsh's approach to Fed policy is deeply flawed." He writes, outsourcing monetary policy to financial markets is a terrible idea. Walsh missed an opportunity to rebuild the Fed's credibility. Bill joins us now for more. Bill, welcome to the programme. We were all watching that news conference, and it didn't start terribly, and then progressively it just got more and more confusing. What was the point in that news conference where you sat up and said, this is weird?
Well, it's weird when you're not explaining why three people are dissenting, yet the committee is deciding on no change in policy. There really was virtually no information about how the Federal Reserve is thinking about monetary policy, how the Federal Reserve is likely to react to incoming information in terms of how they adjust monetary policy. The silence of Walsh was really quite deafening, and the financial markets, basically said thumbs down. I mean, the fact that the 30-year yield went up, the 10-year yield went up, and 2-year yields dropped really was a sign that, that there was a loss of credibility in that from that press conference.
Bill, I want to highlight a distinction because I think it's important, and it's in the body of your op-ed, and I want to say it for you. You're not against reducing forward guidance. This is important. I think that the complaints about the people doing the complaining often are around the idea that somehow we still want our hands being held, that we want to hold on to the post-GFC communication architecture. And Bill, I don't think that's what your criticism is about.
No, I mean, I wrote a group of 30 paper that we published in April, and one of the recommendations was to get rid of forward guidance. The only time you really need forward guidance is when you're at the zero lower bound for interest rates and you're trying to provide additional monetary policy stimulus. But the rest of the time, it really just sort of inhibits the Fed and probably makes the Fed a little bit slower to react to incoming information. But that doesn't mean you don't want to know what the Fed's monetary policy reaction function is. And I think that's the real problem. Walsh in his comments is conflating the two, and they're very, very different. If I don't understand how the Federal Reserve is going to react to incoming information, I can't price financial markets correctly. And it's also creating a lot of uncertainty about what policy is going to be in the future. The market response on Wednesday was really Fed credibility has lessened, and I think this is a really own goal on Kevin Walsh's part. I think one of the problems here, I think, is he's overpromised and underdelivered. He's talked about sea change at the Fed, radical regime change, but then the markets are actually getting very, very little in terms of guidance on how to think about the new Fed.
Bill, we were discussing about whether maybe some of this was by design. There is going to be more volatility. There has been more volatility both at the front end and the long end in response to every economic data point and comment coming from anyone on the Federal Reserve as a result of an absence of some sort of reaction function articulated by the FOMC chair. Do you think that this could be by design to help reduce inflation without hiking rates?
I don't think this is a really great strategy for a couple of reasons. Number one, it's a very inefficient way of tightening financial conditions. Basically, you're driving up risk premium in markets. That's a deadweight loss to the economy. Number two, how well can you actually control the market process to generate the impulse that you want to slow the economy down sufficiently? And lastly, it's a credibility issue. I mean, if to the extent that the markets reacted the way they did on Wednesday, that's telling you that people are more worried about the Fed's resolve to do the job. That means inflation expectations are less well anchored than they were prior to the press conference. That in itself makes the Fed's job harder.
Bill, how high is the bar for there to be, I don't want to say mutiny, but the bulk of the FOMC committee voting against the chair, potentially with the governors joining suit?
I don't think we would get to that. I think at that point, Walsh would throw in the towel and vote with the majority. I can't imagine a situation where the chairman allows himself to be outvoted by the committee, because if you had that result, it basically would be saying that the chairman has lost control of the committee, and that's just not a very good look for any head of any organization.
Bill, he was also vague about the inflation target. That was confusing too. Vague on the inflation target, whether they'd respond to it, and what tool they would use to respond. Can I pick up on that last point, Bill? He's flirting with the idea of using balance sheet instead of short-term policy rates, short rates.
Well, I think
what do you think of that?
Well, I think the problem here is that even if you reduce the balance sheet, you're probably going to be able to reduce it by about $1 trillion or so if you want to continue to have an ample reserves regime. And I think the commitment of the committee is to maintain the ample reserve regime. And then the question is how much restraint is shrinking the balance sheet by $1 trillion going to be? It's actually going to be very, very small. So the idea that, you pull on this balance sheet lever and that allows you to not have to tighten monetary policy, I think is very much exaggerated.
It's obvious that for the market, the primary tool is still the policy rate, because you can see that in the reaction this morning to the sensitive economic data that we got moments ago on wages. They came in hotter, labour costs. You saw yields rise at the front end of the curve. Bill, we've talked about this all morning, the credibility hit. You say credibility's been hit. Others agree with you. Let's talk about how you repair it. When you do a job really badly, sometimes you have to do more than you otherwise would have had to do. How much more do they need to do now at this Federal Reserve to regain that credibility?
Well, I think you have to follow up talk with action. So I think that what's happened in financial markets over the last 72 hours or so basically increases the pressure on the Fed to act in September. If it's a jump ball in September, you almost need to tighten now because you have lost credibility over the last couple months.
Do you think that it increases the chance of a larger than expected rate hike?
It's possible, but I don't think that you're so far away from your inflation objective that you need sort of shock therapy. If the Federal Reserve did 50 basis points move, that would be, in my mind, a little bit of a sign of desperation. Why didn't you hike in July and then you do 50 basis points in September? I think that's actually is a confusing narrative as well.
What do you think the overall motivation is here? I mean, we've been talking about this, and a lot of people said Kevin Walsh is a 100% respected person by the mainstream of the financial markets, by the establishment. Do you think this is just rookie's error, the classic kind of first press conference of a Fed chair? Or do you think that there is some political motivation here trying to dodge the ire of the president going into the midterm elections?
I can't judge that, but I generally think, no, that he's not trying to do it to sort of mollify the president. I think he really does believe that somehow outsourcing this to financial markets will improve the conduct of monetary policy. But you can't outsource it to financial markets for a very simple reason. Markets don't price to what the Fed should do. They price to what they think the Fed will do. And so if you try to outsource it to markets, all you have is the markets looking at the Fed looking at markets, and the interest rate path is indeterminate.
It's the
so
Spider-Man meme that we were talking about yesterday.
Yeah,
Everyone's pointing at each other.
And I saw a couple versions of that. Fed, markets.
I'm sure you did. But it's good to see you. Thank you, buddy. Bill Dudley there, the former New York Fed president. Thank you very much, sir. Appreciate your time. Employment labour costs. Employment costs coming hotter than expected, and you see the reaction in the bond market. It's notable. 2-year yields are higher by a few basis points. Equity markets pulling back. Lisa, the S&P just about positive.
Yeah, and this is something that Beth Hammack was talking about, that she does see the longer this kind of inflationary backdrop continues, that she does expect it to get more embedded in the market, and that there is not a rate that's sufficiently restrictive to really bring down that inflation. Look, we all want to see wages go up, and at some point, it really speaks to the productivity nirvana that people have been hoping for. Question is, if prices keep going up that much more, it doesn't ease the pain that a lot of households are feeling.
There's one letter that stands out for me this morning. You asked about regaining credibility, we both did, and you asked about whether they'd do a jumbo hike. I don't think they're going to do a jumbo hike, but I think you're in the right frame of mind to ask that question. The letter I'm thinking of is S. When Khajuria elaborated on his dissent, he didn't talk about hike, he talked about hikes. He talked about incremental hikes. That's a guy who's willing to go more than once. And I just wonder how many people look to signal the same thing.
Yeah, the idea of 75 basis points of rate hikes that an increasing number of Wall Street companies are looking for.
Is that the way you would have needed to communicate things if you'd hiked, let's say, early this week on Wednesday? Possibly not.
Yeah, well, and at the same time, we need to have some sort of reference point if they start hiking about what their lodestar is. Is it going to be a series of methodical hikes, or is this going to be something that is sort of a case-by-case basis? I mean, that kind of articulation is required for markets to not get ahead of themselves and possibly price in 150 basis point of rate cuts. This is where the reaction function matters.
Futures this morning positive by about a tenth. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie has more. Hey, Vonnie.
Hey, John. Thank you. China's moonshot continuing to rely on Western semiconductors to fuel its AI development. Sources telling us here at Bloomberg the company has a compute power agreement with Alibaba for the use of around 20,000 NVIDIA chips. New York is suing Kalshi for allegedly running an illegal gambling operation. The suit alleges Kalshi's prediction market exposes residents to, quote, serious personal and financial risk. New York also accusing the company of failing to acquire a gambling license. And an update on situational awareness. The Financial Times reporting the fund's manager, Leopold Aschenbrenner, is vowing to fight another day. In a letter to investors yesterday, he said he took full responsibility for the events, which led to a 67% plunge in assets in July. The fund, though, still up 80% on the year. And that's your Bloomberg Brief. John.
Vonnie, thank you. Aschenbrenner adding, according to the FT, that the situational awareness fund would no longer borrow money from banks to magnify its bets.
Lesson learned. Guess what? I think we're going to get out of the leverage business.
Yeah, I'm not sure what that line of credit looks like right now anyway, but
that's fair
you know,
point.
more credit to it. He'll keep swinging, right? I don't know him personally, but those kind of people, they'll keep swinging. This won't set them back.
He's 24 years old, and he has done an incredible amount in his years.
It's impressive.
It is
like,
so
really,
impressive.
Really impressive.
I'm sure he learned his lesson. I'm sure that Citadel gave him a schooling, and now he's going to go off
No doubt.
Lay the groundwork for something else.
I'm not in the business of knocking that guy.
No, not
Just
at all.
Not at all.
I mean, honestly, this is what experience is, and he's getting it.
It's a major experience. Up next on the programme, Dan Niles of Niles Investment Management as the tech sector posts a major rebound, plus Yahira has your morning movers. A clinical trial setback sends Novo shares lower by close to 9%.
Chairman Walsh is really a dove at heart. I mean, he's a structural dove. He got the job for that reason. And all of this is just a veiled way of delaying the rate hike. Sometimes, let's admit, too much brain power is counterproductive, right? It just is. What the heck are all those 200 economists doing on the staff of the Fed? What is the FOMC supposed to do? This lack of trust was revealed, I think, in the presser the other day.
We asked Terry Wizman for his movie review from Wednesday. The news conference with Chair Walsh lit up. That was the most excited I've seen Terry in like years.
What do you think? 25% on Rotten Tomatoes? And what do you think he was actually giving?
If you ask Wall Street, yeah, that rating, Wall Street economists, that rating was pretty low for Wednesday.
It was one of the every single one was just that like green kind of.
And you tune
flat.
into it because it's so bad. Like,
Actually,
like
it's
right
true.
on the edge of that.
It was relatively entertaining.
One of those movies. Equity futures this morning positive by a tenth. On the Nasdaq up by 0.75%. The opening bout just around the corner. Let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. We start with Novo Nordisk, whose shares are plunging in the pre-market, down nearly 8% after a major blow to its pipeline. One of the company's most closely watched experimental drugs failed to reduce the risk of heart attacks and strokes in a late-stage trial. And this is a problem because this is a drug that was supposed to drive the next leg of growth for the company beyond obesity and diabetes drugs. Now let's get to the earnings that we've gotten this morning, because we've gotten some interesting reactions. We are seeing AbbVie, this is the company behind Botox. Shares are down 3.25% despite delivering better than expected earnings. But after a 13% rally this year, investors were looking for even more, but they did not get a clean beat since AbbVie did issue a lower full-year profit outlook than expected. And it was a similar story over at Colgate. Shares are falling nearly 2% despite the toothpaste maker posting solid results, beating on earnings, but it did post weaker than expected sales in North America. It said that it's seeing a slowing consumer demand and tougher competition, but these reactions just underscoring how high the bar is this earnings season, and of course raising the question of what it will take to take this market meaningfully higher from here. John.
Yahira, thank you. Thanks for this morning. As we count you down to the opening bell, your trading diary shaping up as follows into the week ahead. At 10 a.m., we get UMich consumer sentiment. At 11, you'll hear from the president holding a cabinet meeting at Camp David. Looking ahead to next week, ISM data on Monday, Tuesday. We start some results again, some earnings from AMD and SpaceX just around the corner.
Very curious to hear SpaceX, given how much the shares have declined and the fact that you're going to have an opening up of the shares to the public float and the ability to sell. Real questions there. Also questions about what it would take to buy Tesla. I'm sure everyone's going to wonder.
Oh, without a doubt. That's like number one question, isn't
100%.
it? Yeah, but the SpaceX call would sound like the Tesla call.
Yeah, exactly. Just tell us.
Yeah.
They'll say it's not prudent to talk about it, and then people ask again.
Let's focus on tech. Tech stocks on track for a second straight day of gains. A big move yesterday on chips of something like 8%. The hyperscalers powering the Nasdaq 100 to its best day since March. Dan Niles of Niles Investment Management writing, looking at Mag 7 results, it's mostly come down to return on invested capital. Google remains my favourite play. Dan joins us now for more. Dan, it's good to see you. I expect you to be slightly contrarian, and that is slightly contrarian after the week we've had for the likes of Alphabet. Dan, what is it about Alphabet and Google that's getting it done for you?
Well, there's three stocks, John, that I like. It's Amazon, it's Microsoft, and it's Google. So if you look at Google, the great thing is the stock got hit. Well, part of the reason it got hit is it reported results before you had situational awareness shut down, and you had the forced liquidation that put a bottom in. But if you look at the actual results for the most important piece, which is Google Cloud, you saw an acceleration from 63% year-over-year growth to 82%. It's the fastest acceleration of any of the cloud vendors that actually reported, and you've got a pretty low multiple on it. So they've got the full stack, they've got the chips, they've got search, they've got a huge amount of cash flow, and I think they're going to be the winner ultimately in consumer AI, which is why I like them. For Amazon, you've got a big infrastructure business there for e-commerce. I think robotics and AI will really help that. You saw AWS accelerate to the fastest growth since COVID, and you've got a 23 times PE. And remember, the S&P is at 21 times, so you very rarely get that. Microsoft is more, I'm increasingly coming around to this view of a lot of people in enterprise want a secure way to get onto using AI. And Microsoft's got about 450 million paid seats. They've only got 30 million Copilot paid seats. And I think you're going to see a lot more businesses say, hey, I want security. I already am using Microsoft 365. I might as well pay for the Copilot. And, that's how I'm going to get there. And so those are kind of the three I like.
There's a lot to unpack there. You mentioned situational awareness, or you inferred that was part of the reason why Google's shares didn't do better when they reported earnings with some of the similar metrics of the likes of Microsoft and Amazon. How much do you think that's been affecting some of the volatility that we've been seeing over the past couple of weeks?
I mean, that's the main thing. And don't forget, they're not the only ones. There's at least three other funds that I know that have got problems. Yesterday probably fixed a lot of that, but situational awareness, because they were running 4 times leverage, and it was long based leverage. You can run leverage if you're hedged, but if you're not, that's a huge issue. And so that's going to force a lot of problems. You might remember Archegos, what happened there. Go back further to long-term capital management. Obviously, you had the bank failures following the rise in bond yields like Credit Suisse. And so the good news with things like that is it washes out a lot of the excesses in the market. And, that's a positive. I mean, what you saw earlier this year in the rise in semiconductor stocks, that wasn't a good thing. Or the move in the Kospi in Korea, that was not good, because a lot of that is just excesses. And when you've got these vertical moves higher, you're going to get vertical moves lower, especially when you have a fundamental catalyst like token minimization, which, I flagged this back in a June 20th note of why I thought there was a speed bump coming.
Yeah.
You put that on top of a highly levered, visible fund that's going to get crushed. This is what happens.
Well, Dan, just quickly, how do you know that there isn't a lot more of that still has yet to wash out? Because this could have been a lot messier than it was. I mean, it was an orchestrated sale with Citadel. It wasn't exactly some sort of fire sale.
It was a fire sale, Lisa. I mean, they did not want to do that at situational awareness. So the thing is that you're always looking for a forced sale, a forced seller. You got that. Now, by the way, other funds that are highly levered, we're also trying to degross, which is why if you look at, something I think I wrote up on Wednesday, I talked about the different metrics and how much the momentum index had come down. Especially if you look at the TMT, Tech, Media, and Telecom Momentum Index, that drawdown was almost 50% in a month. And that's longs minus shorts. And so what you had was your longs are getting crushed. Your shorts are going up. And if you have leverage on top of that, that's magnifying the losses. And so we've never, ever seen a move in this short a period of time with that magnitude. And so, human beings, our nature hasn't changed, right? Which is fear and greed. You got a tremendous amount of fear going into Wednesday.
Dan Niles of Niles Investment Management. Dan, thank you. Have a great weekend. To Dan's point, the last point, really important, the speed. The amount of time it took for this to unwind, the speed, because of the leverage that had to be unwound, just accelerating the whole thing.
It's the reason why people thought that it wasn't really healthy to see a vertical increase, a sort of exponential increase to just up and to the left. I guess to my question, up and to the right, my question is, how do you see what we're seeing with SK Hynix and Samsung and the Kospi this morning and say it's all over, considering how big those gains are?
A good reason or a convenient excuse to, say that we've got a nice base to rally from here?
Because people still like the names, and so why not?
A lot of people believe it. You're starting to hear it a little bit more going into the weekend. Coming up on Monday, Sarah Hunt of Alpine Saxton Woods, Frank Lee of HSBC, Neil Dutta of Renmac, Nancy Lazar of Piper Sandler from New York City this morning. Good morning. Thank you for choosing Bloomberg TV. Have a wonderful weekend. This was Bloomberg Surveillance.